ఆడియో వస్తుందండి?
రావట్లేదండి.
ఓకే.
Yeah, I was about to ping you, Sudhir garu. Yeah.
Start checking. ఆడియో ప్లే అవ్వట్లేదు నాకు.
రావట్లేదండి ఆడియో.
అదే
లేదు.
చూస్తున్నాను. సార్ మామూలు వితౌట్ షేరింగ్. Something weird. నాకు దాంట్లో నుంచి ఆడియో రావట్లేదు. జస్ట్ 1 second.
Sudhir garu, share sound, probably option missed.
అసలు వీడియో దాని నుంచే ప్రాబ్లం వస్తుంది. Just 1 second.
Okay.
నా దగ్గర సమ్ ఆడియో ప్రాబ్లం ఉందండి. ఒక్క నిమిషం. ఆడియో ప్రాబ్లం ఉందండి.
America.
ఆడియో ప్రాబ్లం.
America.
ఇంకా రావట్లేదండి.
So I'm having some technical problem అండి ఇక్కడ ఆడియోకి. So shall we go ahead and with the program? I'm having some technical problem ఆడియోకి. So shall we go ahead and with the program? I'm having
I think last time mute లో ఉన్నప్పుడు you were not able to play the audio and the volume. If you last time mute లో ఉన్నప్పుడు you were not able to play the audio.
ఆయన ఇప్పుడు మ్యూట్ లో ఉన్నారా మధ్య?
రిపీట్ అవుతున్నాయి, ఎకో వస్తుంది. Is it only for me or everybody else?
అలాగే ఉంది అందరికి. I guess we should just start maybe. Chat లో ఉన్నారు. మనం స్టార్ట్ చేయొచ్చేమో.
Yeah, I agree. I think we should start.
ఓకే. గుడ్ ఆఫ్టర్నూన్ ఎవ్రీబడి. నమస్తే అండి. నా పేరు అరుణ గంటి. ద NATS చైర్వుమన్ అండి ఈ ఏడాది 22-23. కొత్త సంవత్సరం లాస్ట్ మంత్ మొదలైంది. కొత్త ఏడాది లాస్ట్ మంత్ మనము విమెన్స్ అవేర్నెస్ సిరీస్ మొదలెట్టాము. అందులో భాగంగా మనము దుర్గా ప్రశాంతి గారు మనకి విమెన్స్ ఫైనాన్షియల్ వెల్నెస్ బేసిక్స్ గురించి చాలా వివరంగా మనకి ఇన్ఫర్మేషన్ అందించారు. She covered a lot of ground, right from passwords to assets, liabilities, goals, budgeting, savings. ఆవిడ చెప్పిన ఒక మాట నాకు చాలా నచ్చింది. She said, hope for the best and plan for the worst. So I think మనం మహిళలుగా ఆ సూత్రం పాటిస్తే చాలా బాగుంటుంది అని నా ఉద్దేశము. దుర్గా ప్రశాంతి గారును మాధవి గారు చాలా మంచి ప్రోగ్రామ్ అందించారు లాస్ట్ టైం. మనకి చాలా మంచి ట్రెమెండస్ రెస్పాన్స్ కూడా వచ్చింది. ఇవాళ ఆవిడ కంటిన్యూ చేస్తున్నారు, మిగతా సబ్జెక్ట్స్ గురించి మాట్లాడతారు. మీరందరూ కూడా మీ పెన్స్ పేపర్స్ తెచ్చుకుని ఆవిడ ఇచ్చిన షేర్ చేసిన ఇన్ఫర్మేషన్ జాట్ డౌన్ చేసుకుని రాసుకుంటారని అనుకుంటున్నాను. థ్యాంక్ యూ దుర్గా గారు అండ్ థ్యాంక్ యూ మాధవి గారు ఫర్ యువర్ వండర్ఫుల్ ఇన్ఫర్మేషన్ ఫ్రమ్ లాస్ట్ టైమ్ అండ్ వీఆర్ లుకింగ్ ఫార్వర్డ్ టు అనదర్ వండర్ఫుల్ సెషన్ టుడే అండి. థ్యాంక్ యూ జయశ్రీ గారు అండ్ జ్యోతి గారు, Lakshmi garu and the entire team for this wonderful program. NATS గురించి ఒక మాట అండి. NATS 2009లో స్థాపించబడింది టు హెల్ప్ ఆల్ ద తెలుగుస్. ఎలాంటి ఆపద వచ్చినా వాళ్ళకి సహాయం అందించాలని మొదలుపెట్టిన సంస్థ ఇది. We do it through a variety of programs. Bhashe Ramyam Seve Gamyam a నినాదం. సర్వీస్ యాక్టివిటీస్ చాలా చేస్తాం మేము, బీట్ హియర్ బీట్ ఇన్ ఇండియా ఆల్సో. మా గురించి, మా సంస్థ గురించి మీకు ఇంకా ఇన్ఫర్మేషన్ పొందాలంటే natsworld.org కి వెళ్ళి you can get a lot of information. We help everybody through 1-888 for Telugu. It is the first helpline that was started by any Telugu organization. 1-888 for Telugu. ఎలాంటి ఆపద ఉన్నా, ఎలాంటి డిఫికల్టీ ఉన్నా మీరు సంప్రదించవచ్చు. There's always somebody waiting to help you. And that's it for now. And I'm looking forward to a wonderful session today. I hand it over to Jayashri garu. Over to you, Andy. Thank you.
Thank you, Arun garu. Andariki namaskaram andi. అరుణ్ గారు చెప్పినట్టు లాస్ట్ సెషన్ లో దుర్గా ప్రశాంతి గారు, మాధవి గారు ఇచ్చిన సలహాలు కానీ, చెప్పిన విషయాలు కానీ ఎంతో మందికి ఉపయోగపడ్డాయని వాళ్ళు మాకు ఈమెయిల్స్ ద్వారా రకరకాలుగా వాళ్ళు మాకు ఇన్ఫర్మేషన్ ఇవ్వడం మాకు చాలా ఆనందంగా ఉంది. ఇది 10 మందికి ఉపయోగపడాలన్న మంచి ఉద్దేశంతో ఈ ప్రోగ్రామ్ చేస్తున్నాము. మేమే కాదు, దుర్గా ప్రశాంతి గారు కూడా చాలా వర్క్ చేసి దీని మీద అందరికీ అవేర్నెస్ తెప్పించాలి అన్నది ఆవిడ మెయిన్ గోల్ అని చెప్పడం వల్ల ఆవిడ సంప్రదించడం జరిగింది. మాధవి గారు, దుర్గా గారు కూడా చాలా వర్క్ చేస్తున్నారు దీని మీద. మీరందరూ కూడా దీని నుంచి మంచి మీకు ఉపయోగకరమైన విషయాలన్నిటినీ మీరు దాని నుంచి నేర్చుకోవడం కాకుండా 10 మందికి ఇది పంచడం వల్ల చాలా హెల్ప్ అవుతుంది. మాధవి గారు, మీరు వెంటనే ఈ ప్రోగ్రామ్ స్టార్ట్ చేస్తే చాలా మంది వెయిట్ చేస్తున్నారు ఇది వినడానికి. సో ప్లీజ్.
థ్యాంక్ యూ జయశ్రీ గారు. In fact, ఈ ఆపర్చునిటీ వచ్చినందుకు we are also very happy. Durga is able to share all her experience, తన ఎక్స్పర్టీస్ అందరితో షేర్ చేసి ఉపయోగపడుతుంది అంటే we are also very happy. Anyway, thank you very much once again for the opportunity. So before we get on with the session, similar to last time, I'd like to go over and welcome our speaker. I'd like to go over quickly our housekeeping rules. Whoever joins, please stay muted. And if you have any questions during the meeting, please go ahead and put them in the Zoom meeting chat box, or Facebook lo join aithe ganaka Facebook page lo you can put in your questions. Maku mana NATS committee team vallu they'll pass on the questions to us, and we'll try to address as many as possible based on the available time we have today. Also, Inkokatandi, last time, I think this is a Telugu association program, but we had many folks, interestingly, other than Telugu, who have joined our program. So I think we would want to continue the session in English, Durga, just a heads up for you. And again, welcome everyone. So for the folks who are joining the session for the first time, I'd like to reintroduce our speaker here. Durga, she's a very close friend of mine before anything else. So I take the liberty of addressing her here and introducing her. She's been a close friend, well-wisher, and an accomplished personality. Many of us have actually benefited quite a bit from her wisdom and her financial acumen over the past two decades, which is and it's been a wonderful journey, not only for us, for her, but also for us to see how she's grown, from what she used to be to what she is right now. Also, her husband Raju, we've been seeing him for more than 2 decades. He's also an amazing person, and Taniki, how he's been encouraging her and a pillar of support for her. We're all very happy for them. She's a mother of 2 kids, 9 and 12 years old. Sorry. Tarvata, not only that, I mean, naakone kadu, most of our friends, we've benefited quite a bit from her knowledge, and she's been a great source of information, great source of inspiration for many of us. Thank you, Durga, for all that. So on the personal front, the professional front, Durga has been an accomplished executive and angel investor with over 2 decades of experience in technology and management. She's currently working for a technology company as a VP of technology and operations for a large nonprofit organization. She's also an investor in startups with successful exits under her belt. Now, prior to this role, she was a founder of a startup and worked as a COO for a software product and professional services organization. She enjoys yoga and Pilates, and she believes that mental wellness and physical wellness, they cannot be separated, they're together. She's very passionate about women's issues and has been an advocate for women throughout her life, as I mentioned earlier. So obviously this naturally led her to start a group called AID. And the mission of the AID is to empower women to make sound financial, career, and life decisions. Not only for women, I'm sure these are universal facts which actually help everybody, not confined to women in particular. So with that said, Durga, can you tell us a little more about AID and why you started AID before, of course, yeah.
No, I think I covered that in the last session, but I think for folks that are new, AID stands for Athena Donna Exousia. Actually, Athena is the Olympian goddess of wisdom and war, and Donna Exousia actually translates to women empowerment, right? So I believe that all women are wise and very powerful, and once equipped with the right knowledge and right information, they can all turn into Athenas in their own life, right? And so our mission is really to empower women to make good, sound financial, career, and life decisions, like Madhvi, you said. Personally, I feel like finances are where women struggle a lot. So AID, even though started last year, we focus primarily on financial basics and educating women on financial basics. So that has been our goal for the last 1 year, and we're continuing to do that. And I'm really happy to be part of NATS Women Empowerment Series, primarily because they're doing the same thing that we are doing as part of AID. So I'm really happy and thrilled to be here, and educating women Again, the financial basics are not confined to just women. They're confined to, they apply to pretty much everybody. So I'm happy to be here. I don't consider myself, fully knowledgeable in all aspects, but I'm here to share whatever I know, and hopefully people can benefit from this. So happy to be here.
Thank you, Durga. And we had a great response from session 1. And for the folks who've actually missed out the session 1, we have the recording on the NATS Facebook page. And because today's session is going to be a continuation of the previous one, we recommend that you go ahead and look at that. However, we would like to do a recap also. So basically, the entire series covers 9 financial wellness basics as part of the supposedly part 2 series. And we've covered 5 basics in the first session, and we will be covering the remaining 4 in today's session. So just to review, recap the previous 9 topics. The first one being understanding the importance of financial awareness, knowing your net worth, set financial goals, establishing and managing a budget, understanding the importance of savings and saving strategies. So we've covered all these 5 topics in our previous session, and we will be continuing the remaining in today's session as much as we can. Now, because we are building on what we spoke last time, I think, Durga, it will be beneficial for those folks who haven't joined to just to, go and at a high level on the previous ones also.
Yeah. So the 9 financial basics, I think today we're going to be covering the remaining 4. We'll try as much as we can. These topics are pretty vast. So managing your credit score is one, planning for the future, retirement is another one, which we hope to cover fully today. And then finding ways to multiply money, which is essentially investment strategies, and understanding the importance of estate planning, so having a will or a trust, and life insurance. These are the other 2 topics. So the remaining 4, we might cover just the credit score and planning for retirement today, considering we're expecting a lot of questions similar to last time. But anyway, so coming to the first 5 things that Madhavi has already mentioned, understanding the importance of financial awareness. This is crucial for everyone, not just for women, but we know that women are really lagging behind when it comes to financial awareness. And that's because we've talked about the societal, kind of traditional nature of the society, and how women have not necessarily been providers of the family until recently. So a lot of these have been established for ages. And so trying to change that in the last 30, 40 years, and women have come a long way, but we still have a long way to go, especially when it comes to managing finances. But financial awareness is important for everyone, whether you are male or female, young or old. Everybody benefits from being financial aware. We all know that financial stress is one of the worst kinds of stress, right? And this is something that, according to the American Psychological Association, about 72% of Americans actually feel stressed about money at one point or the other, right? So this is something that everybody worries about. So it's really important when we know that financial stress is really hard to deal with. Being financially aware helps manage your financial stress. So that's why it's very, very important. So we talked about the importance of that. We played a video last time, which was really powerful. And again, Madhavi has already said this, that if you have missed that first session, please go ahead and watch that session in detail on NATS Facebook page or on YouTube. But today we'll just recap at a high level. So the next point that we covered was knowing your net worth. So once you know that you need to be financially aware, the next thing is to know where you are financially. So are you doing well? Or are you not doing well? So the most important thing there is to come to terms with that, right? How good are you or bad are you when it comes to finances? So knowing your net worth is important. So net worth is essentially your what's left over after you subtract your liabilities from your assets, meaning that what you own minus what you owe, right? And then there comes a number. So if you manage, if you have an asset worth $500,000, but you have debt or loans and things of that sort worth $400,000, then your net worth is about $100,000. So it's very important for every single person, whether you are making a lot of money or very little money, doesn't matter, whether you're young or old, it's important to understand what that number is. That is what we call net worth, right? Once you understand that number, once you get to that number, you identify gaps. So you basically say, well, I wanted to be, at a certain number when it comes to my net worth, and I'm not there. And that means that there are gaps, right? You're not saving enough. You're not essentially doing well financially, in which case you can take those gaps and turn them into financial goals. So that was the third topic that we discussed last time, was talk about financial goals, how to set financial goals. We've talked about financial goals being broadly falling into three categories, right? They fall into short-term goals, medium-term goals, and long-term goals, right? So short-term goals could be, I want to get rid of all the debt, credit card debt I have. So maybe you have $10,000 in debt that you want to, essentially, take care of. That could be a short-term goal. $5,000, $4,000. I know we have people of varied age groups that are joining this session. So I know that not everybody is old enough to have so much expense, right? But that falls into a kind of a short-term goal. Let's say medium-term goal would be buying a house, for example, or saving for kids' education. So if you are somebody who's married and have young kids, and you know that they're going to be going to college soon, saving for their college education falls into kind of the medium-term goals. Long-term goals are, really long-term, right? Planning for your retirement, maybe you're wanting to buy a vacation home, things of that sort. Really long-term goals that may take a long time, right? So retirement is really one of the big, one of those biggest, kind of goals that is universal for everybody. Then we talked about how do you accomplish those goals, right? What is the way to accomplish these goals? What's the best way to do that? The best way to do that is by establishing a budget. So establishing a budget, for your entire household, right? Taking into account how much income you're getting from all the different sources that you may have, and then figuring out what are your expenses and thinking about, are these essential expenses or are these non-essential expenses, right? Essential expenses are groceries, putting food on the table, paying for utilities and things of that sort. Non-essential expenses could be shopping, entertainment, things of that sort, right? And then, saving and beyond that, right? So you want to make sure that you have, you're able to take into account all your expenses. You look at your income, take into account all your expenses, essential and non-essential, and also look at, saving as well as part of your budget, right? Why is it important, right? Because saving is a mechanism through which you'll accomplish your financial goals that we've talked about, which was the third point. Short-term, medium-term, or long-term, you can't accomplish those goals if you're not saving money. If you're essentially getting your paycheck and drawing that down and completely spending that money, you're not going to be ever able to achieve any of your financial goals. So that's very important to understand that concept and save. The key thing that we talked about here primarily was discipline, right? Being very disciplined with your finances is important. Setting a budget once and forgetting about it is not good. You have to continuously evaluate it and make sure that your budget is adjusted accordingly as your income changes, your expenses changes, things of that sort, right? So we've talked about that being a key. And we talked about at least do it for 6 months to a year, and then it becomes pretty natural for you, right? After that, you don't have to think twice about it. So discipline is really key here, right? Then because we talked about saving, and saving is the only way you'll accomplish your financial goals, we talked about different strategies around saving, right? We've talked about saving automatically. When you get a paycheck, immediately take a portion of that paycheck and put it in a savings account. So do automatic savings, because most banks these days allow you to automatically move money into other accounts. When you're receiving your paycheck, make sure that you're automatically moving that money. You can even talk to your employer to send money directly to your savings account instead of sending it to the entire paycheck to your checking account, for example, right? So those are critical things. Make sure that you're establishing an emergency fund in case, we've talked about, Aruna Ganti Garu has actually mentioned about this. You hope for the best, plan for the worst. There are things that can happen. You may lose your job. There may be certain things that can happen. So, you may be, for whatever reason, you may have a lot of medical expenses, things of that sort. You may not be suddenly able to increase your income or may be able to get a job, in which case you need to be able to have a fund that you can use to be able to fund those particular, when those events occur, right? So that's an emergency fund. We've talked about that. Should be at least 3 to 6 months of your salary, monthly salary, that you should put in an emergency fund. We also talked about, saving anything that comes. So let's say you get a bonus or you suddenly get a tax refund. using that money and saving that money, saving that money, not necessarily utilizing it. So don't think of that as, oh my God, I hit a jackpot, I'm just going to go out and spend all this money on shopping and things of that sort. It's not a good idea, right? Anytime you have unexpected income that is not your traditional monthly paycheck, take that income and then invest that or save that somewhere so that can be used for your future, right? Also think about making sure you're refinancing your mortgage. You look for, there's certain things, take advantage of things that are happening so that you can save more money, put more money back into your pocket, then you can use that money to save for your future, right? So we also talked about a few strategies, 50-30-20 strategy, 50-15-5 strategy. Primarily the goal there is, only 50% of your income should be going to essential expenses. That could be your roof, rent, mortgage, utilities and groceries and things of that sort. 30% could typically go to your non-essential expenses, entertainment and things of that sort. Obviously we don't want people to have a dry life and not to be fun, right? So we want to make sure people are enjoying their life, but at the same time, save 20% of the income and to either pay off your bad debt. When I say bad debt is usually credit card debt. Pay off that debt, or put that towards save that and then multiply that money. So we've talked about those strategies. The biggest thing is to, before you think about saving, make sure you don't have any debt. That's what we've talked about first, right? Don't have any bad debt. Good debt is debt that when you borrow money for your home, that is considered good debt because usually you can secure a very low interest rate for your home loan. Those things are okay to have. Those are good things to have, especially because you can borrow at such a low rate. You'll not be able to make that kind of, you'll never be able to borrow at that low of a rate anywhere else. So it makes sense to keep good debt, but essentially take care of bad debt, which is, personal loans and things of that sort that you may have, or credit card debt where you're paying really horrendous amounts of money in interest. So that's what we talked about when it comes to the 5 topics that, become financially aware, know your net worth, set your financial goals, establish a budget to then realize your financial goals, and then understand the importance of saving and saving strategies to then be able to, meet your goals in a quick fashion, right? So those are the things that we talked about.
Right. And not that many people, not that people are not aware of these basics, but it's just that, they need to be, they need to follow this like a mantra. It's like a formula for success, right? Financial success.
Absolutely.
Definitely are all great inputs to help us move forward in our financial growth. So the next topic, so you've covered the 5 topics on a high level so far. So the next topic of discussion for today is about the credit score. Can you tell us more about that and why it is important?
Yeah, we have a variety of people joining, and as far as we heard from even the last session, we had young people join and really older people join, and we have housewives and we have men as well that have joined. So I think like we said, these are universal topics. Before we get to talking about credit scores and all of that, let's just talk about some basic terms, right? A lot of people talk about credit. What does credit actually mean? If I were to summarize that in one word, I would say it's debt, right? Credit is a fancy word for debt, right? And essentially it tells you, it's a way to measure credit scores or credit reports or credit bureaus. These are all trying to measure how risky is it to lend money to you, right? So because they're looking at your debt repayment history. So let's take an example. So let's say you borrow, so you have a friend A that comes to you and he borrowed money from you. They asked for $1,000 and you gave them money for whatever reason. And you expect them to pay you back in 3 months, right? Let's just say that. And they promise that they will do that, right? But 3 months come and go and they don't pay you back. Now they may end up taking 3 years to pay you back. So you still got your $1,000 back or $1,000 back, but they took very long to pay you back. Now, let's say after 3 years, this person A comes back to you again and asks you money. Are you going to be willing to lend them money? The answer is usually you're going to think twice about it because you expected the money to come back to you in 3 months, but it has not come back to you in 3 months. It took them 3 years to repay you back. Now, now that this person is not really worthy to be given any more money or lent any more money, right? So now that person A that we talked about goes to another friend and that they talk to that friend and they say, can I borrow $500 from you? That other friend doesn't know anything about what happened between me and that person A, right? So they are oblivious and they're going to go and lend that $500. What might happen typically, because they may end up paying it back quickly or may not, right? But if that person, the third person, came and talked to me, I would have suggested not to, give that person money because of my experience and the history that I have with that person. Now think about how can we make sure we know. So now we're talking about financial institutions, large banks and stores that are trying to essentially lend you money, right? So they want to be very sure that they can lend money to people that will repay it back. But how would they know anything about your history of repayment? And that's where this whole credit score, credit history, and credit reports come into play, right? First, let's talk about credit bureau or credit reporting agencies, right? So in United States, we have we have other credit reporting agencies, but we have three major credit reporting agencies: Equifax, Experian, and TransUnion, right? These reporting agencies, their main goal is to collect information about each person, every person in the United States, that whether they're citizens or not, collect information about their how many debt accounts they have. We call them accounts and credit accounts. Do they have their history of repayment and how much did they borrow, how much did they pay back, and if they had any issues, right? Let's say they didn't pay it back, and or they declared bankruptcy or other types of things. They collect all this information. So not only are they collecting this information, they're then sharing this information with lenders, with everybody. So if I'm a lender, somebody that I am in the business of lending money to people, then I am actually working with one of these credit reporting agencies or credit bureaus to be able to pull a report, right? And this is the report. What is a credit report? A credit report essentially is it's like if you go to a doctor and they take a blood test and give you a blood report. What are they going to do? They put all the information. They'll put your name and your information, your age, your gender, things of that sort, and they'll kind of put all the markers of what they found, right? Similar to that, a credit report shows everything about your debt, how you manage debt in the past. That's what credit report will show, right? So any lender will be trying to pull a credit report before they give you they give you money, essentially. So it is very important to understand this, right? And it starts very early, right? As soon as you start earning, you can start building your credit history as early as when you start earning money, or even if you don't earn money, you should be able to start building your credit history. So when kids are at 18 or so, they can start building their credit scores and credit histories. And without a credit history, you can't have a credit score. So let me just say that before we get to credit score, we have to understand the credit history, right? So as I talked about, the credit history just gives somebody an idea of how you manage debt in the past, right? And then a credit score essentially is nothing but it's a very quick way to give a lender an idea of, it's a 3-digit number, right? That gives a lender a very good idea of how risky or safe it is to lend money to you, right? They could obviously go through the entire credit report and they can, look at every single aspect in the credit report because it could be very detailed. But the point is, you want to get to it very, very quickly. So you want to be able to understand looking at a numbers, and that's what a credit score is. So every time we talk about credit score, we kind of inherently are talking about credit reports and credit histories and all of that. So before they calculate your credit score, you need to have at least 6 months of credit history to be able to have a credit score. So that's basically how this aspect starts. Hopefully, this is kind of enough for people to understand what when we say credit score and credit history and credit reports. Maybe that hopefully this makes sense.
Taking a deeper dig into it, right? So how do these credit bureaus determine the score?
Yeah. So like I said, it's a 3-digit number. The credit score is a 3-digit number, right? It falls between 300 and 850, right? So technically it doesn't start at 0. Most people think that it might start at 0. It doesn't actually. So it starts at 300 and goes up to 850, right? And this kind of depicts the person's credit worthiness, as we call it, right? Are they worthy of being lent money to, right? That's basically it. So credit score is essentially rating your credit risk, right? And then the credit score is based on obviously your credit report and your credit history, right? So what is in your credit history typically? Credit history contains things like the number of open accounts, the number of accounts or debt accounts, if you call it, their accounts. So how many credit cards do you have? How many loans do you have? And how much debt do you have that is being revolved, right? So let's say you have 2 credit cards that are, that have a limit of $1,000 or $10,000, let's say 5,000 each, for example. But you may be utilizing at any given point about $5,000 in of that credit limit, right? So you have $10,000. You already have $5,000 in debt that you owe to these credit card companies. Now that basically is what the amount of debt that is revolving. So that's what is called revolving debt, right? How much money or how much debt is outstanding at this point? So a credit history will contain that as well. So it's going to say on a credit report that this person has 2 accounts, 2 credit cards, a $10,000 of credit limit. They have $5,000 in debt, right? That's what's going to show. And then it's also going to show how much, and these credit card companies expect you to pay this money back on a regular basis, right? And it's also going to show whether you've been making those minimum payments, those payments are being made or not. So it's going to see those types of things. So it's going to show their on-time payment, right? If they have on-time payment, it's great because they're saying you're such a great person, you're financially responsible, you're paying, you're not only borrowing money, but you're actually making payments regularly when the company is expecting them. So taking the example of my friend, if my friend promised that, I'll be paying you back $300 in the first month, $300 in the second month, and the remaining in the third month. If they were doing that consistently, I would be willing to loan them money in the future, right? A similar concept here. So that is essentially what we'll be tracking. And a few other factors, delinquencies and things like that. These are fancy terms. I don't want to go into them at this point. But the score is really based on these things, right? And each of them have a different weightage, right? So for example, and before I go into the weightage of this, let me just talk about the score itself, right? So we talked about 300 being the lower side of the score, and then 850 being the higher part, end of the score. Now, if you have excellent credit score, and when you say I have, you are the most financially responsible person, you are in the excellent credit score category, right? So you are anywhere between 800 to 850. Let's say you're not quite there, you're fall into the next rung, which is very good, which is 740 to 799. That means that you're very good. I mean, you're good financially, responsible financially, but you're not quite at the excellent level, right? And then the next one, good, falls into 670 and 739. So it kind of goes down that way. So it's a range typically, right? When you fall within that range, you get that kind of, I have excellent credit score versus very good, good, fair, or poor, right? You definitely don't want to be in the fair, poor category. You may start at good and then keep growing to very good and excellent. That's the goal, right? So that is kind of how that goes. So let's talk about how this credit score is calculated now, right? As I said, it's based on these factors. How many open credit card accounts do you have, or credit accounts you have, not credit card, in your payment history, like how often were you supposed to make payments and did you make those payments, right? And then the total amount owed, which we talked about, the debt, revolving debt, and then length of credit history. They also look at that. So if for example, if I'm lending money to a person that is borrowing money for the first time from me, I don't have enough of a history to basically know whether I should give them more or less money, right? So if somebody comes to me out of the blue, asks me for $10,000, I may be not willing to give them that money. I may be giving them $500, but not $10,000. In order for me to give them $10,000, I need to see that they have in the past borrowed that kind of money and repaid it back. And that's why it's important to kind of see that a longer credit history that you have, the better it is, right? And then the types of credit. So you use your credit history primarily made up of credit card accounts, or does it have other types of debts as well, like the good debt we talked about? Good debt being mortgage debt, like when you borrow money for your home loan, that's considered good debt, right? They look at that. Having good debt is very important. They like that, versus they don't like revolving debt, which is considered the credit card debt, right? And then also, how often are you applying? So let's say, again, let's take an example of new credit, right? So how often are you applying for new debt? So for example, taking the example of the person that I talked about, that person came to me and asked for money. Then go and ask another friend for money, and they go and ask another friend for money. What does this tell you? There's something wrong with that, with their financial situation at this point. which means that it's a little bit of a risky situation to give them money. If somebody knows that this person is asking for money in 5 different places, that tells me that they may not be in a good financial place to lend money to, because there's a high chance I may not be getting my money back. So that's the reason why new credit also is very important. How often are you applying for new debt essentially is also taken into account. So just to summarize here, payment history makes up 35% of your score, right? That's the number one thing. So that's the one thing that you have in your control. Make sure you make your minimum payments, right? Then you have total money amount owed. That makes up 30% of it. That's the next big one, right? So even though you are capable of essentially spending $10,000, because we took that example of somebody has $10,000 in credit limit, they can spend the entire amount of money, but the credit bureaus, in this case, the credit reporting agencies, don't look at that in a good light. They want you to be able to have only about 30% of that. Like, so if you have $3,000 or less in debt, they like that. Anything over $3,000, they're not going to like that. So that makes up 30%, but they also look for your total debt to be 30% of your total amount of money you can borrow, right? Then the length of credit history makes up 15% of the remaining, of the score. Then types of credit we talked about, like installment credit or revolving credit, good debt versus bad debt. They're going to look at the type of the accounts you have, and then that makes up about 10% of the score. And new credit, anytime you're applying for new debt, that makes up 10% of your score. So that's how they calculate it. Each of these credit bureaus actually have a proprietary formula. When I say proprietary formula, it's loosely based on FICO, right? FICO is the score. Anytime you hear credit scores, usually you'll hear it's a FICO score. FICO actually stands for Fair Isaac Corporation, and they actually came up with the score and a model to calculate a score that falls between 300 and 850. So most of these credit bureaus actually follow a version of that, and that's what they use to kind of calculate the score. So keep in mind that each of the credit bureaus calculate the score a little bit differently. You don't have the same score across all 3 credit bureaus. And each of the lenders use different, they only pull some lenders only work with Equifax, some lenders only work with Experian, some lenders only work with TransUnion. So they're pulling those things. So it's very important to kind of make sure that your score remains in an excellent or a very good category in all 3 agencies, because you just don't know which lender is going to be using which credit bureau to pull your credit history or your credit score from. So it's very important to kind of make sure that you understand that the score is not a static score. It changes from each credit, from one credit bureau to another credit bureau.
Thank you, Durga. So this is obviously very important, right? From somebody who's fresh out of college to all the way, into old age. But at the same time, there are many intricacies as to why this is so important. Can you explain, put some light on that?
Yeah, no, it's so, and we talked about all the mechanics of it, right? But let's talk about why this is important. If you are an adult, it's very, very important that you have a good credit score, right? Why is that? Because as part of an adult, you're going to do adult things, which are like renting a home, getting a cell phone on your own, right? Maybe applying for, utility, right? Cable, water, power, or gas. Simple things like this, even cell phone, right? Buying a cell phone requires you actually, even buying a cell phone, they're going to check your credit score. They're going to check your credit history before they give you they let you actually buy a cell phone even, right? Renting an apartment, they're going to check your credit score. So basic things that you have to do as an adult cannot be done without credit scores and credit histories, right? So it's very important if you start at a young age, right? Your credit score is always a work in progress. You can always continue to improve. It goes down and up and go down and up, varies constantly, but you have to make sure that if you have the basic awareness, you're going to make sure that it's always staying in kind of pretty much consistent, right? It's because everything is dependent on this credit score and credit report, right? Basic things depend on it. So, and also it determines how much deposit, for example, if you have a bad credit score, not that people are not going to rent you an apartment, but the problem is they're going to ask for a big security deposit because they worry that, if you're not unable to pay, then I should have enough to cover that. So they ask for a big security deposit. If you're, applying for a credit card or applying for a loan, they're going to, depending on your credit score, they're going to charge you higher or lower interest rate, right? So if you have bad scores, then they're going to charge you very high interest rates. And if you have good scores, they're going to charge you lower interest rates. Isn't that wonderful? We talked about savings before, right? How important is it to have a good credit score, a great credit score, for example, because you'll be paying less in interest, which means that more money left in your pocket, more money to save for your future, more money to save and multiply so that you can increase your net worth. It's a wonderful thing, right? So it all starts with the credit score, and this is the single most important thing, that you should do, and teach your kids as well, that, to focus on this early on, right? So that's why I would say the credit score is very, very important.
Right. Can you also explain about how the difference, between the credit scores, like having an excellent versus having a very good? I know you've explained quite a bit, but if you can.
Yeah. I mean, a good question, actually, right? But so as I explained before, if you have an excellent credit score, they may not even ask for a security deposit, right? In the case of if you don't have a very excellent score, they may ask you to put in some amount as security deposit for certain things, like renting a home or buying a cell phone. They may ask you to say you have to pay upfront this much, and I'll let you borrow the rest of the money. Things of that sort. And then interest rates, right? Interest rates for credit cards, for example, if you have an excellent credit score, may fall between 12 and 15%. So they still charge you high interest rates when it comes to credit cards, but you kind of fall into that lower interest rate category, just in case you have an unforeseen circumstance where you need to borrow money from, spend your credit card and use a lot of the money from your credit card. That's fine because your interest rate is lower. Whereas if you have not very good credit scores, then you can see your interest rates could be, in the 30s, 30%, more than 30% sometimes, over 25%. And that's really scary, right? So that's why it's quite important to kind of do, essentially pay attention to this, you always try to be in the very good or excellent, category, not anything below that.
So having said that, let's say if somebody has a lower credit score, what are the ways to improve that?
Absolutely. So we talked about what's in the credit history, right? So how are these credit reporting agencies determining, how worthy a person is to be given money to, right? So that's basically based on whether you're paying your bills on time, just as we talked about, right? Are you paying your bills on time or not? Like, it's not just borrowing money, pay the money back on time, and people will be a lot more confident to give you money. So that's first and foremost. If you're not paying your bills on time, make sure you're making those payments on time, right? If you if you have a history of not paying on time, it takes about 6 months to show that you've been making payments on time for your credit score to increase. So that's important. So understand that just because you start making payments in the first 2 months, you don't see your credit score change. That's because it takes a good 6 months for you to make on-time payments to then see your credit score increase, right? The other thing to think about is we've talked about the amount of revolving debt. So I've given an example before. You may have 2 credit cards, 5,000 each in terms of credit limits. And right now you are spending, let's say you have $2,500 balance on one of the credit cards or both the credit cards. So that's below 30%. So 30% is about $3,000. So 2,500 means you're at 25% of your overall utilization. So you're not utilizing all of your debt. You're only utilizing 25% of your debt. That's good. But let's say you get another credit card. Let's just say that. Or you called the existing credit card companies and said, can you increase my credit limit? They may say, okay, you've been good and you've been paying on time and all of that stuff. Let me just increase yours. Let's say it now went to 20,000 is the new limit. So each one increased your credit limit by 5,000. I'm trying to make it easy. That's why I'm using bigger numbers here. But so let's say now your credit overall, your total credit limit is about $20,000 instead of 10,000. You still have only 2,500 in debt, right? Which is just what you've used, that's the balance. Now, if you compare that to what you had before, it's like 12.5% of your total utilization, which is great because now they're going to look at that and they'll say, wow, you're way below the 30% mark. You're doing a wonderful job. So another way to think about it is try to find a way to increase your credit line. So that you show that percentage of utilization, keep that at a lower amount. So keep it always below 30%. But the way to do that is by increasing your credit limit as well. I wouldn't go and start applying for a lot of credit cards to increase it, because that is going to hurt you as well, right? So we don't want to do that. But find a way to, if you're doing well and you can call these credit card companies and increase the credit limits, that's one way to do it. Also, second thing, let's take the same example. The third thing is to not close any credit card accounts. A lot of them, people say, I'm not using this credit card. It's bad to have this, so I'm just going to close this credit card. And a lot of people do this, right? It's a really bad idea to do that. Again, the same reason why I said this before, take the same example. The person had $5,000, in one credit card and $5,000 in another credit card. They had $2,500 in debt across these two credit cards, right? Now, let's say they have $2,500 in one credit card and the other credit card they're not using. It had $5,000 left, right? They're like, you know what? I don't use this anymore. I'm just going to close this account. I don't want to use this anymore. When they do that, what will happen to your credit utilization is that it's 2,500 out of 5,000, because the other 5,000 doesn't exist anymore. You close the account, right? So it doesn't exist anymore. So now you owe $2,500 in debt out of the $5,000. Suddenly your credit utilization actually went up to a whopping 50%. So it's no longer 30%, 25%. It now went to 50%. That's not going to be seen as a good thing by the credit bureau. So make sure you never close credit card accounts. Always try to find a way to put some small purchases on these credit cards so that you can repay them every month, pay them in full every month. So $10 here, $10 there, that's pretty much it. And then just continue to keep those credit card accounts open, right? Also, when you close your credit card accounts, if that credit card was something that you got very early in your, in your life, that is actually part of your credit history. The longer credit history you have, the better it is. So they might look at that and say, you close a credit card, that actually hurts you in a way. So make sure to not close your credit cards. So that's another way to improve your credit score. If you do everything, but your credit score is not improving, you can actually contact some credit repair companies that can help you increase it. And you can also, there are some smaller programs that each of the credit bureaus actually have that allow you to call them and they'll tell you how to boost your credit score quickly, So certainly do that. But biggest thing is pay your bills on time. Continue to do that for 6 months or so to see an increase in your credit score. Find a way to up your credit line, increase the credit limits, and then don't close any credit cards, right? That's kind of the key there.
Thank you, Durga. Definitely, these are some very intricate details that quite a few folks miss out, especially like not closing out on the credit cards. Those are a few things that everybody needs to be aware of, because there's not we need to do. Just leave it out there, and maybe pay it off once in a while, right? Every month.
Yep.
So that was a pretty good detail. And what about those people who actually, have not had any credit history before? How do they build, like, let's say housewives who've never had any credit cards and they want to build their credit history?
Great question. So I think we're talking of people that may not be earning money, right? I mean, so folks that, housewives, they're not earning money. How do they build their credit history? And there are a few ways you can do that. First and foremost, if you can become an authorized user of your spouse's credit card, right? So they can add you as an authorized user on your you can get added to your spouse's credit card, and that's one way and they'll be paying the credit card, making the credit card payments, and you will essentially get some credit for that. So first thing is, if you are not just housewives, but if you have young kids that you want them to encourage, you want to encourage them to build their credit history, you might want to just add them as authorized users on your credit cards. That's one way to do that. But it's not the best way, but that's one way, right? So start, at least that's the easiest way to kind of at least start. Make them an authorized user on some of the credit cards. Next thing is, if you're a student, if you have a student loans, usually they understand that when they're, giving you student loans, they're not, looking at a ton of history here. So you're going to be able to secure a student loan. If you do that, if you're young, make on-time payments on those student loans, and you are going to be able to see your credit score increase. So that's another thing. Card loans are also simpler things that you can potentially get, that you can, with not much credit history, you can obviously you can ask somebody to co-sign those car loan payments, right? So get a car loan, but have somebody co-sign it. So if your spouse is working and you're not, get your spouse to co-sign it, and then you can add your name to it, and you can potentially increase your, build the credit history and then the credit score. The other easiest way to do this is to apply for store credit cards, right? So you go to Best Buy, you go to Gap, you go to some of these things, and they all offer credit cards. You go to TJ Maxx, and they'll keep saying, oh, yeah, do you want to open a credit card? Every time you check out, they'll keep asking. Those ones are easier to get. They also carry really high interest rates, and they usually are less, they don't scrutinize as much when they're lending, letting you borrow this. They might not, if you don't have any credit history, they might not allow you to do, borrow a ton of money. Their limit may be like $300 or $200, but that's still okay. What you can do is you can get those and use that, make a purchase and then repay it quickly in full. And that will build your credit history. So that store credit cards is another way. Now, these are all simpler things. If all of this doesn't work for you, so let's say none of this works for you, the other way to do is there are two other ways to actually build credit history, right? One is a secured credit card. Actually, most people have not heard of this, but there's something called a secured credit card. The way that works is that you actually put down a deposit. So you say you want to get a credit card for $500, right, as a credit limit. They'll ask you to put $500 down. So, if you're not working and you should borrow money from your spouse and give the credit card company $500 as a deposit, then they'll give you a credit card with a $500 limit. Now, take that credit card, now start spending, on that, use that credit card everywhere you go, and make payments on time. As we talked about, making payments is the best way to build your credit history. So borrow the money, so swipe the card, then pay that back quickly and immediately. If you can do that in full, that's wonderful. If you're not able to do that, at least make the minimum payments and then keep that going, right? So as you do that, and make sure these secured credit cards, most of them are reporting all this back to the credit reporting agencies. They're sending the information back about you to the credit reporting agencies. That's another way to build it. So secured credit cards work that way. Similar to that, if you have there's something called credit builder loans. These loans go, you can go to most of the local credit unions, and they have something called credit builder loans. These are for folks that don't have any income or anything. They work the same way as a secured credit card. It's like a loan though, right? So they let you take out a loan for $500, but they ask you for a deposit for $500. And then they give you a loan, and then they'll ask you to, and then you take that loan and then you're repaying it back. And that actually shows up on your credit history and will look and increase your credit score. So these are ways you can do it, right? Authorized user is the easiest way. If you can't do the authorized users, you can employ multiple techniques. It's not just one technique, right? So you can both be add as an authorized user on an existing credit card, on your spouse's credit card. Then if you have student loans and things, make those payments, get a car loan, get somebody to co-sign that, so that you can, they're making payments, but your name is on the loan. And so you're able to build your credit history. If get a store credit card, if you can, only go get a store credit card from a store that you frequently shop at, and that makes sense. And then, obviously pay off, because those store credit cards actually have very high interest rates. Then you have secured credit cards and credit builder loans, like we've talked about. So those are the other ways you can build your credit history. So housewives or young students, young adults, these are ways you can build your credit history and your credit score.
Yeah, so many alternatives out there. Thank you, Durga. So on the same lines, we have a question on the chat from one of our viewers. If we have a dependent card on a primary card holder, and we use it as a spouse, on whose name does the credit history be built?
So if you're an authorized user, then it will, that's why I say it's actually, that's what I was trying to address earlier. If you're an authorized user, which is essentially means that you have a card, you got a card with your name on it, because you now an authorized user of that credit card. That means that it will be reported with the credit history. But those things are not as valuable as something on your name, right? And that's why it's important to think about secured credit cards and credit builder loans. Those are foolproof ways to build your credit history. Authorized user is the simplest way, at least to get started, but that's not the only way, I would suggest.
Okay. Yeah. On the same lines, again, we have people who are on H4, they don't have SSN, right? So they should be able to build this credit score on the similar grounds you've mentioned.
Yeah, actually. But so there's some changes though that we should talk about here, right? So if you have their dependents or folks that have no SSN. So because they're not working, they didn't get an SSN. In that scenario, what you can do is there are credit cards and there are that allow you to actually apply for a credit card with there's something called an individual tax identification number or an ITIN number. So how do you get this ITIN number? You actually have to go to IRS and ask for this number. So if you don't have an SSN, apply for ITIN number. And this ITIN number will allow you to then apply for credit cards and essentially even checking accounts. So if you want to go and open a bank account, you can use your ITIN number to be able to open a bank account. So you don't have to have an SSN to do that. So there are some credit cards like, with no SSN. Go Google it, you'll find this. Go search for credit cards that don't require an SSN. And you will find some well-known cards like, big banks that are doing this, Capital One and Bank of America. These folks, these are big, banking, corporations that essentially are offering these types of cards, right? But they will expect you to put your ITIN number, to be able to get those things. Again, you could still do the same thing with, with the store credit cards as well. You could use your ITIN number. You could also get a secured credit card using an ITIN number, and so on and so forth. So the key is, if you don't have an SSN, you have to have a different identification number. Make sure when you're using that they're able to report that back to the, check and make sure that, the company that is lending you money is essentially reporting the information back to the credit bureaus. Always ask that. If you do ask that, then you're good. So whether you have dependents on others, you can certainly do this, do it this way, ITIN number.
Okay. On this, again, we have a similar question here. Can we add a minor child to an adult credit card?
That's a good question. I think there's nothing stopping you from doing that, but because they have an SSN, you can always add, a minor to that, 16, 17 years old. I'm sure you can add them, and they will be able to reap benefits from it. As long as you have an SSN number and you're uniquely identifiable, credit bureaus will recognize you.
Is there an age limit for someone to get a secured credit card?
I actually don't know the answer to that. I think that's I would have to find out.
Okay. Is it a good idea to keep credit cards even though you're not using it? I think you've answered that.
I answered that question. Don't close your credit cards, use them, because if you don't use them for a long period of time, the credit card companies will close those accounts. So you don't want that. So obviously you want to make sure you're putting in small purchases on those credit cards and making the payments. Always, use the automatic payments, right? Make sure automated payments are in place so that you're paying off those small, $10 here, $5 there. Just think about small amounts. Even if you're not using it, just use it for small things to pay off every 2 months or 3 months or something like that. That way you can just continue to keep that credit history.
One more question. If we have cards with no balance, but still we apply for a loan, they look at it at how much is our total credit limit and decide the loan, it seems. Because we could borrow or use all that money from credit cards if needed and may not be able to pay off their loan. So I've been told to keep your few credit cards and less limit.
That's actually a good question. So just another tidbit, right? On an average, most adults actually have 4 credit cards. Some people have 10, 15, right? Is that a good thing? No, right? Maybe if you have 4 or 5, that's okay. But most people have that. That's the average, right? So I think it also depends on how long your credit history is, right? When you go and apply for a loan, they're not looking at one thing. It's not just about the total, and how many credit cards you have and all of that. If you have too many credit cards, that's also not going to be seen as a good thing. And how frequently have you been opening these accounts? That's not going to be seen as a good thing. So when I'm talking about don't close your credit cards, keep your credit cards to a minimum amount and make sure that you're utilizing all of those. Don't just go off and buy more, get more credit cards. And that's the reason why I said increase your credit limit with your existing credit cards, the companies, rather than get another credit card. Right? Always go and say, hey, I've had it for, same limit for the last 2 years. Can I get an increase in the credit limit? And that way you're not going and getting another credit card, but you're just increasing, the limit on the existing credit card. So that works fine. So I would suggest keep your credit cards to 4 or less, 5 or less, but don't go over that. And I think then it will hurt you badly, right? Because people are not going to think of you as, I mean, if you have so many credit cards, they're just going to look at you as, oh my God, this is a disaster waiting to happen. At some point, they're going to just draw out a lot of money, and that may be very risky, right?
That also answers your this other question. Less credit cards are better than having more credit cards was one of the questions.
Yeah, but I think you don't want one. That's the thing. It's like, if you're one, then you have no other choice. Even one is not a good thing, right? It's just like, start with one, increase it to 2 or 3, but keep it that way, right? And don't just go off and buy, but just doesn't mean that you just have one credit card, right? Because you just want to make sure that the entire limit is high enough. So in case when you're borrowing money, it doesn't ding you badly. They don't ding you badly on the credit score.
Thank you. So can we talk about the secured credit card that you mentioned? I think that's relatively new to many of the folks. And
yeah. Let me just take an example on that one. I think that may be useful. Like, we said that, technically.
I think somebody is not on mute. Yeah, we're good. Go ahead.
Okay, sounds good. So let's say, like I said, you go to, get a secured credit card, they'll ask for a deposit, $1,000 in deposit, and then you go use the credit card and you go shopping, and make sure that it's less than 30%. So if you're $1,000 of credit limit, because you put $1,000 as a deposit, your $1,000 credit limit, then you have to make sure that your debt on that card is not less than $300, right? So make sure you go off and purchase something for $100 or $150, and then the next month pay it off in full, pay off $150 in full, right? And then go next month, spend again, and then pay it off in full, and do that consistently for 6 months. And then after 6 months, your credit history will be built, and the credit score will start increasing, right? And also, there's another trick. So sometimes go over the 30%. So let's say, you have $1,000 of credit limit, right? Spend $500, right? But then pay it off in full, right? Do not make minimum payments at that point. They like to see that you're spending more, but you're also paying it off. So they like to see credit, most of these credit bureaus and these lenders want to see that even if you borrow large sums of money, they're able to see you pay it fully back very quickly, immediately in a month. That's a good thing. So that kind of a thing would also be helpful, right? So also remember that, so they don't know, these credit reporting agencies don't know what's in your checking account. They don't know how much money you make. They don't know any of that. They only are looking at your debt history, right? How much debt you have. They're not looking at how many assets you have. So you might say, well, I'm doing well. And, just because my credit score is bad doesn't mean anything. I'm earning a lot of money and I have a lot of assets. They're not looking at that. They're only looking at your debt repayment history. So it's very important to understand that it's not about how much money you make, right? They're not looking at, they're blind to that. The only time when they're looking at the money is when they're, the credit card companies are deciding how much limit to put on a credit card. So they're going to ask you questions about how much is your income and all of that. But the credit reports and the credit reporting agencies don't look at any of that. They only look at, hey, what your limits are and how much debt you have. And that's pretty much it. So make sure that you're showing by doing that. Let's say you're spending a lot of money and then you're paying back immediately. That kind of shows them that you have enough disposable income that you're able to spend and you're able to pay it back. That's kind of a good thing, right? So they're now getting an idea of, hey, you're able to spend $10,000 and pay it back. That means that you have that kind of money, right? Which is good. So that's the kind of stuff I think, people should remember. Credit scores and everything is all about debt. They're not looking at your assets. They're looking at nothing, right? But you want to give them an idea of how good you are financially. And that's why this is important. So sometimes go over that 30% limit, but pay it back immediately the following month, fully, right? It's always better to pay it off fully rather than just doing minimum payments. But make the minimum payments. That's the important thing.
Yeah, I think we spoke a lot about the credit cards, credit scores, credit histories, and all that, credit bureaus. So can we just, summarize on a high level, just to end that topic and before we move on to the next topic?
Yeah. So as I said, credit score, credit report, credit history, all of this is kind of depicting how financially responsible you are to other lenders, to other people in the world. I mean, sometimes you believe it or not, for some jobs, people do check your credit score and credit reports, even to employ you. That's also, prevalent in the sense. So it's very important that you're showing that if you're financially responsible, people know that if you're financially responsible, you may be great in other areas too. That's, you become very worthy candidate to be giving money to and all of that. So it's very important. Also, we talked about, you can also keep your bad debt low, right? When you have good credit history and good credit scores, you'll have lower interest rates on credit cards, lower interest rates on your loans and things of that sort. So especially bad debt when it comes to credit card debt, you're not going to be overpaying anywhere, right? Even when it comes to good debt, when it comes to loans and things of that sort, two people can be making the same amount of money, but when they go to get a loan for a home or a car, they may get completely different interest rates. Why? Because of the credit score. So I may be making $500,000, somebody else may be making $500,000 or $100,000, whatever that may be. I just, when I'm applying, I may get a very low rate and another person may get a very high rate because their credit score is bad. So it doesn't matter. So for you to be financially responsible, you need to make sure that you're managing your debt very well, right? And it also means that you can get a bigger loan and lower interest rate, which means more savings for you for later on for other things. So it's very important to do that, because it can be very, you may be able to even own a bigger house because your monthly payment is low, because your interest rate is low, and you're able to now pay more towards a larger house and get a larger, mortgage loan also. So all of these factors, as we've talked about, being an adult means that you have to do certain things. And to do those certain things, you need to have good credit history and good credit score. Simple things like renting homes and, getting the utility company to open an account for you. All these little things that we think about, buying a cell phone, all these things require credit score. So it's quite important to have that emphasis early from really, early in your life, right? Even if you haven't done that, it's never too late. So I'll always say that, start now.
Everything seems to be tied together so closely here.
Mm-hmm.
Again, our next topic here for in today's session, which is the 7th topic, is a retirement. So can we talk about retirement?
Yeah, no, I absolutely. I think we touched upon a few items last time, and we've shared some numbers with folks, and I'll want to do a recap of that. Before I want to get to that, I want to cover a couple of things first, right, before we get to that topic. So let me ask you a question, Madhavi, right? So let's say today I give you a penny, right? A penny, it's 1 cent, right? I give you a penny and I say that's going to double every day, right? For the next 30 days. Or I will give you $1 million today. Which one will you take?
I'll go ahead and pick the $1 million.
It seems like a wise choice, doesn't it? Right? It does feel like a wise choice. Let me get the $1 million. I mean, that's guaranteed. What am I doing with a penny? I can't even buy anything with a penny today, right? But think about it, right? So this penny is doubling every day. So that's on day 2, it's now 2 cents. Day 3, it's 4 cents. Day 4, it's 8 cents. Can you guess how much is it in 30 days?
I need my calculator here now. I haven't even thought about it.
Okay, you think though it's going to be less than $1 million, right? Because clearly you chose $1 million first, right? Now you think it's going to be less than the $1 million, right? It's actually $5.4 million at the end of 30 days. So if you just let it go for one more day, right? 31 days, it's $10 million. So now you think about this, right? It's an eye-opening thing for folks, right? So you think about the penny that's doubling. It's a humble penny. What am I going to do with this humble penny? You walk around, you find a penny on the road, and you don't think much about it, right? And then you think $1 million is, wow, this is such a big amount of money, and I'm going to pick that. But the magical penny is doubling, right? And that doubling is giving you a lot more money, later on that you don't see. Actually, even on day 15, for example, how much money do you think you would have? That this penny is doubling, right? On day 15. Day 30, we know it's $5.4 million. Day 31, it's 10 million. What do you think it's on day 15? Just roughly guess.
Definitely less than a million, I would say.
No, it's actually on day 15, it's $163. Can you believe that? It's $163 on day 15. So that's the key. So what am I trying to tell you all here? This is what we call the power of compounding. So the penny is compounding, right? The penny is doubling. So the doubling is really the compounding part. The day 2, it's doubling from there. And it's doubling from there on, right? So the key here is the power of compound interest. Simple interest is that, you bought $100 and you say, I'm going to pay you 10% simple interest. That means that at the end of 1 year, I'm going to give you $10 back, because that's $100. 10% of that is, then, so if you continue to keep the $100 for another year, you still owe 10% in interest. So you're going to get 10% only. But with the power of compounding, at the first year, at the end of first year, the 10% compound interest, at the end of first year, you're going to have $100 plus the $10 in interest that you got for that month, for that year. And the next year, the interest will be calculated on $110, not on $100. In the case of simple interest, that's what's being calculated on $100 only. The principal amount is what will continue to stay the same. But in the case of compound interest, you're actually getting, this is simple math. We all learned this in grade school, right? This is what we have learned. But that's what's happening to that particular, the penny is an extreme example because it's doubling. I mean, nothing doubles, like that. But it's an extreme example, but that kind of gives you the same concept here, right? So let's assume that, just to make it easier for people to understand. So let's say you take $10,000. You're at age 25, you took $10,000 and that's the initial deposit. And then you're on a monthly basis, you're adding $100 to it, right? So you started with $10,000 and you're on a monthly basis, you're adding $100 to it. So on a yearly basis, you're adding about $1,200, right? Let's say you leave that for 42 years. You do that for 42 years as, like that. Started with 10K at 25, added $100 a month for the next 42 years. And let's assume that you're getting a meager, very, very, very kind of humble 7.5% rate of return on that investment. So you're putting this and somebody said, you're going to get 7.5% in return. What do you think will happen in 42 years? It's actually $526,000, by the time, that money that started at 10K and you're adding only $1,200 a month is now at $500,000, right? If you assume that you get a better return than 7.5%, 10.5% would be $1.4 million. What I'm trying to tell you here is start early and then let the power of compounding take over, right? Start early, start investing early. Investing is also for, the example that I took is 42 years. So if somebody's 25, they retire at 67. So they have 42 years to go, right? So if you were young and you just started working, put away this money, right? In retirement, that's, we were talking about retirement. So I'm going to take the example of a retirement. If you just start with $10,000 and put away $100 a month, just simply in 42 years at, basic rates of return, you're going to get, you're going to have close to $1 million or more in savings. So then that's important. That's why I keep saying start early. When you start early, you might not see much of an increase that's happening, right? You might say, yeah, well, just take the penny example. Day 15 is $163. You're kind of like, what am I getting? I mean, it's doubling, but it's only $163. What am I doing with this? So you might feel the same way, but your returns will start, you're going to see bigger and bigger returns as this becomes a snowball effect, right? It's the interest being added back to the principal, and it's growing and growing and growing in size until, and the returns is happening on the bigger amount now, right? So that's why that's key when it comes to power of compounding. So that's one aspect I want to kind of drill into everybody's heads about the power of compounding. The second thing is, how do you know how much is there a quick way for me to know that how I can double my money, right? Like, so quick way to calculate how quickly I will be able to double my money. I'm not going to tell you how to double your money. I'm going to tell you how to calculate how to, how easy is it to get to that number, right? So let's assume that you have $100, right? And let's say you're investing in some instrument, and now you think you're going to get 10% interest on that $100. How do you know when this $100 becomes $200? Because we talked about power of compounding, right? So 10% in compound interest. So how soon will I see that $100 double to $200? So you may be curious to know this when you're investing money into, stock market or 401k or something else, you know that as long as you know the rate of return, you can easily calculate how long it will take to double that. It's called the rule of 72. So I'm going to repeat that. It's called the rule of 72. So taking that example, you take the 10% compound interest. That is what you're going to get, right? You have $100 is what your initial amount is. And you want to know how long it's going to take at 10% rate of return, how long it's going to take to double that money to $200. It's a simple formula. It's you take 72 and divide it by 10%, which is the rate of return, right? That gives you 7.2, which tells you that it takes about 7.2 years, because let's assume the interest was being calculated on a yearly basis. It's going to take 7.2 years for you to, for that $100 to double to $200, right? So that's how you can easily calculate it. So as long as this can be used in positive and negative scenarios as well. So the same thing can apply to debt, right? So let's say you owe somebody money, right? And you borrowed $100. Now you're paying 10% compound interest to them, because these days nobody pays simple interest. You're paying compound interest. So if you're paying compound interest to them and you don't repay them fast enough, you're now going to, that $100 that you initially borrowed now became $200 in 7.2 years because of 10% interest rate, right? So rule of 72 helps you really quickly, to understand how to, how long it will take for you to double the money. So it's just a quick formula. So 72 divided by the rate of return. That's the way to kind of calculate that.
I like that rule, just to get the money, not to repay.
Yeah.
I mean, I can't even imagine that. And by the way, I'm stuck with the fact that you made me realize that I've lost $4+ million with that penny example that you've given me. That's quite an eye opener for me.
Yeah.
Thank you.
Yeah.
Yeah, go ahead. Sorry.
So let me actually since we were talking about retirement, I wanted to talk about those two primarily because when we talk about retirement, it's a long game, right? And we want to be able to start early and invest early in your life, and then let it, it's almost like set it and forget it, like put the money away and then continue to fund it and then forget about it for many, many years. And then know that at the end of, when time comes for your retirement, you're going to have a big, a huge amount of money left, waiting for you to kind of tap into. That's why it's important to start early. So if you have young folks, listening to this, start when you first start your job, right? When you first start earning, start putting money away for retirement, right? That's a way of saving, start saving in something long-term, right? Don't just, spend all the money. That's the key, right? So anyway, so that's the thing. So, but we did talk about a few things last time about retirement. So let me just do a little bit of a recap on the retirement aspect. So we did talk about we're not all saving enough. If you just take the stats in America, we're not saving enough. And especially Indians don't think that, 401ks are a good idea. We're not I've seen a lot of people around me that are not saving enough when it comes to retirement at all. And they're finding other ways to invest in other places, and hopefully they can use those for retirement. But really, we are missing out on some good strategies, for saving for retirement, right? So it's very important that we save for retirement early. We also talked about some numbers. How do you know whether you're saving enough for retirement? Let's say you're doing something towards and saving. How do you know whether you're saving enough? So if you're in your 30s, for example, you just started, you're in 30s, you at least should have 1 to 2 times your annual salary in retirement savings. If you're in 40s, it's 3 to 4 times. And then if you're in your 50s, it's 6 to 7 times. And then if you're in 60s, it should be 8 to 10 times. Obviously, more than that is always wonderful, right? But at least that's kind of a somewhat of a, you can actually think of it as a level that you want to be at the minimum, right? That's the minimum you want to be at. So just pause and think about where you are today, right? If you think about how much you have in your retirement and compare that to your annual salary and say, and think about your age, and are you where you need to be? If you're not, I will tell you, most of them are not. And that's basically the reality of the situation, right? And we also talked about how much money do you think we would need in retirement, right? Most people need about 80% of their pre-retirement income, after retirement as well, to continue to, do their, manage their daily, or household, essentially. So it's called the 80% rule. So, if you're making $100,000 now, let's say you retire tomorrow, you have to have at least $80,000 in retirement income that's coming every year so that you can survive, right? That's the way to think about it. Also, one of the things we've talked about is start early, save early, and then forget about that, right? That's what we've talked about. But if you're starting to save, if you're young and you're just starting to save 10 to 15% of your gross income towards retirement. So if you're in your 20s, start with that 10% or 15% of your typical rule is 15%, but start with as little as 10% of your gross income. So if you're making $100,000, take $10,000 and put it towards your retirement immediately. That's on day one when you start your employment. Do that, right? Also, understand that you have to take matters into your own hands. We've talked about this as well last time. In the past, when in the olden days, people used to get pension, right? And people used to be looking forward to retirement because they would get pension from the company. And people used to generally work for the same company for 30, 35, 40 years. And they guaranteed that they would get a certain amount in pension when they retire. And people were happy, right? Because they didn't have to think much about it. They'll retire and they'll get some money, and they'll, that's the way to think about it. Now, we don't have any. I mean, I can count on my fingers companies that actually offer a pension plan, and they're not, no employer is offering these things today, especially due to privatization. Hence, you need to take the matters into your own hands and have to save money on your own, because nobody's doing that for you. Right? Don't spend the money that you're making every single month. Don't live paycheck to paycheck, live below your means, save, right? So that you can put away, sock the money away for future needs. So that's the key. So understand that it's in your hands. Nobody's going to be able to help you with this, but you, right? Okay, so that's kind of what I think we covered last time. Do you remember anything else that we covered last time, Madhavi?
I guess that's pretty much it. Can you also explain about to our young adults, like who are in their early 20s, right, as to why this is so important to start early?
Yeah, power of compounding is one. I don't have to explain that again, but that's really important. But also when you're young, right, you don't have a lot of responsibilities. So you may not own a home, you may not have kids, and you may not have a spouse, you may not have any of those things, which means it's easier. There's not a whole lot of burden on you at this point. So it's easier to save for retirement when you're young, right? Because you don't have a ton of responsibilities. Also understand that, when you're saving for retirement, especially when you're putting in retirement plans, qualified retirement plans like 401ks, 403bs, IRAs, Roths, things of that sort, you're investing, usually not Roth, but investing pre-tax dollars, right, into so which you're getting a tax break essentially. So it's also important to understand that, right? When you're younger, and you're in a lower income tax bracket, it's easier to start putting money away, especially in Roths and things of that sort. We can talk more about Roth IRA, but we've talked about compound interest. So and also it becomes a habit. So if you start early, right? If you started when you're 21, 22, 23, or you're 25, you're starting early and you're doing this now. We've talked about discipline. It's very, very important to make this a habit, right? You're not at 25, you're not thinking about retirement at all, right? But that doesn't mean that, going back to hope for the best, plan for the worst, right? You got to plan for this situation. It will happen eventually. You're going to grow old eventually. So you got to save now. And saving now, taking the penny example again, you're going to see larger returns later on in your life. You're not going to see them early on in your life. So it's important to just put it away, let it just multiply on its own, for a long time, and you would be good to go.
Thank you, Durga. And can you explain about the different sources of retirement income?
Yeah, no, I know we keep talking about 401k and you kind of forget that. Are there any other, sources of income, or is this just the only source of income, right? So there are different sources of income other than 401ks and things of that sort. But let's cover what are the few, categories. So typically you have your 401k employer sponsored retirement plan accounts like 401k or Roth 401k. You also have IRAs, which are called independent retirement accounts, individual retirement accounts. These are, something that you can individually fund. You don't have to be working for somebody to be funding the IRAs. And then you have Social Security benefits, are the other ones that, I think we did get a question last time, so we'll be covering a lot more of that this time around. But Social Security benefits are the other, area, where you can get retirement income from. HSA is another one. Health savings account, we kind of talked about it last time as well. Fund your HSA. We can talk more in detail about it this time also. And then if all else fails, you have personal savings. So maybe you invested in some other areas and you have to sell those assets and other things to be able to fund for you towards your retirement. So really it's, 401ks, employer sponsored retirement plans like 401k, Roth 401k, IRAs like IRA, traditional IRA and Roth IRA, Social Security benefits, HSAs, and all else fails, personal savings. That's what you have. Those are the different sources of income.
Thank you, Durga. So we keep hearing a lot about 401k, and everybody's into savings into 401k. But there are many of the Indians who start their career on H1Bs, and they start off as contractors, and they don't really have these employee benefits of retirement savings. So how can they avail?
Yeah. And I think that's the, so if you don't have an employer sponsored plan that you can take advantage of, which is a 401k or a Roth 401k, the way you can take advantage of it is, at least you can put away some money in IRAs, right? So traditional IRAs are a way to do that, right? So this does not require that your employer sponsor this, so you can put it in a traditional IRA, but the limits are lower. 401ks and Roth 401ks have higher limits, so you can contribute a lot towards those retirement plans. Whereas with IRAs, you will not be able to. Why don't we do this before we get to Social Security, which I think a lot of people are interested in. Let's just talk at a high level about 401ks and Roth IRAs, and then get to Social Security in a little bit. We're at 3:30. I'm doing a little bit of a time check here, and let's see. We have another 20 minutes or so to go, so we'll try and see how much we can cover in that time frame.
We have a few questions in chat, so we need to spare some time for that also. So.
Perfect. So let's try and go through some of this quickly, and if we need to cover this in another session, we'll certainly do that. I certainly don't want to rush and finish some of these things because these are basics, and we want to make sure everybody feels comfortable with these. So let's talk about some few things that I've noticed about 401k. So before we get to Social Security, let's talk about 401ks, Roth 401ks, and IRAs, right? Important things, what I notice when it comes to 401ks is that first and foremost, let's talk about a scenario where you are working for an organization that does have a 401k plan that they are offering. What I notice in that scenario is that most people are not contributing enough to their 401k plan. That's number one. So first and foremost, you're not contributing enough, not maximizing. Second, you're also not, even if you put some money into your 401k plan, you're essentially not managing where that money is being invested. So just because you put money in a 401k, it's not automatically going to grow. You're going to figure out a way to make it grow, right? And usually 401k plans have funds that they are, the employer has chosen. They'll usually say, okay, these are the best funds for my employees, so I'm going to make these funds available to you. Those funds usually provide a certain rate of return, right? So you're investing in those funds, you're going to get a certain rate of return. So you have to make sure that you're putting your money in the right funds so that you're going to see a rate of return. So just putting money away in a 401k may not mean that it will multiply and be, and it grows, right? Other thing to do is you have to actively manage it. That's the key. And most people don't actively manage it, even if they put the money away. And then the third thing is people do change jobs, frequently, right? Frequently enough, every 4, 5, 6 years or so. And when they do change jobs, they keep the old 401ks with the old employer. They don't roll it over. So typically you have to take that money and roll it over into an IRA, which they usually don't do. So these are typical things that I notice. People are not doing that, and there are problems with that. But before we go into all of that, let's just say, how much money can you contribute towards your 401k, right? And we'll get to Roth in a little bit. 401k, you can contribute for 2022, you can contribute about $20,500. That's your own money into your 401k, which is a lot of money. That's pre-tax as well. So you're not paying any tax on that because it's taken out of your pre-tax, salary. right? So you can put up to 20,500. That's the key. Now, you actually can put in more than 20,500 if you're older than 50. So 50 or older. So let's say you're 50 years of age or older, you can actually put an additional $6,500. So it's now your limit is 27,000 instead of 20,500. So if you're younger than 50, your contribution limit is 20,500. If you're older than 50, it's 27,000 because it increases it by 6,500. So that's key. Most people don't know this about the 50-year mark, right? As soon as you hit 50, you can actually save more towards your retirement. The other thing to also remember is employer contribution. So a lot of these employers actually contribute money to your 401k. So how does that work? Typically what they'll do is they'll say, if you put 3% of your salary towards 401k, you contribute, which is the employee is contributing. The employer will match 3% also, which means, let's take an example. You're making $100,000. I'm always simplifying, I'm using simpler numbers here. I know everybody makes a different amount of money. $100,000 you're making, and you take 3% of that and you put that into a 401k. So that's $3,000 you put into a 401k. The employer will say, I will also match $3,000. So because that's 3% of your income. So they're now going to match $3,000. So you put $3,000 that counts towards your 20,500 limit, right? Because your limit is 20,500. But the $3,000 the employer is matching doesn't count towards that. Actually, you can contribute 20,500 on your own. The employer contribution, the employer matching, as we call it, is not going to be counted towards that limit. That's going to be over that. So if the employer is contributing, can contribute a lot of money, to be honest, they can contribute up to 61,000. You can actually in total between the employer and the employee, towards one retirement account, you can contribute up to $61,000, which is huge. Most people don't know that, right? But your employer has to be, contributing on your behalf because you have a limit of 20,500. You can't contribute any more than that. Anything more than that is coming from your employer. If your employer is doing that, then you can actually sock away about $61,000 into your retirement every year, right? Which is huge. So certainly, if you are, people don't know this. So, if you don't know that, understand that. So a lot of the times people say, my employer is matching. So I'm trying to make sure everything is 20,500. No, you can put 20,500 and your employer match 3,000. That 3,000 will be in addition to your 20,500. So that 3,000 goes in, and now you have 24,000, 23,500 instead of 20,500 in your retirement account, right? So just keep that in mind, right? And then usually 401ks are capped for high income individuals, but that's not something that I want to cover here. But Roth 401k also kind of functions the same way in the sense that they have a similar limit. So let's say my employer offers 401k and Roth 401k. Can I contribute $20,500 toward my 401k and then $20,000 towards my Roth 401k? The answer is no. You combined, you can actually put in only 20,500. So the key here is in 401ks, whether it's Roth or traditional 401k, you can only put in 20,500 of your money. And if you're over 50, it's 27,000. It's together. You can't do double dipping in both these areas, right? But what's the difference between Roth and traditional 401k, right? Roth 401k is funded with post-tax dollars, right? It's not pre-tax, whereas 401k is pre-tax. Roth 401k is post-tax dollars, which means that the employer, when they offer a Roth 401k, they're going to take out the tax and then fund that 401k, Roth 401k. So that, just keep that in mind, right? It's post-tax dollars. But the advantage of a Roth 401k is that now, because you funded it post-tax, it's growing tax-free. And when you get to retirement and you take that money out, you don't owe any taxes on Roth 401k, 0 taxes. You can take the entire money out, you owe 0 taxes on it, right? But you have to do that because it's a Roth 401k, which means that you can only do that when you hit retirement age, after 59.5 years of age. That's when you can start tapping into it. But currently the regular retirement age is 67. So an early retirement is 62, right? So, you have to wait until then to be able to take this money out. It's not that you have to wait until then. if you can take the money out, but you'll be paying some penalties and paying taxes and things of that sort if you do it before retirement. But the key is Roth 401k is a great vehicle because you're going to put post-tax dollars in there, and then it'll go tax-free forever. And then when you actually withdraw the money, it's tax-free also. There's no tax owed on it. Whereas a 401k, you actually only defer the tax. So you're putting in pre-tax dollars in there, and then it'll continue to grow tax-free for a long time. So even if you see, so you put in $100 and it grows to $200, but you're not yet at retirement age, you're not paying taxes on that $100 that it increased to. You're only going to pay taxes when you withdraw and when you hit retirement, when you withdraw the money. But by that time, you're going to be in a lower tax bracket because you're not working anymore, things of that sort, and how much money you're withdrawing. But at that point, you're going to be, paying less, right, in taxes, hopefully, because you don't have any other income, and this will be the only income that you might have, in which case you're not paying a whole lot in taxes. But the key is it's growing tax-free for a long period of time, and then you would pay taxes, when you actually withdraw the money based on whichever bracket you fall into, right? At that, whatever tax bracket you fall into at that point. So 401k, Roth 401k is really, really good, right? And most, actually about 3 out of 4 employers now are offering Roth 401ks. Most people don't know this. So suggestion would be to put in half your money in 401k and half in Roth 401k, if you can. After the 20,500, maybe do that if your employer offers that, or put more money in Roth 401k if you think that that's a better way for, because you want to not pay any taxes when you retire. That's the best way to do it, right? But also remember, if you're over 50, you can contribute more, right? So that's the key. Also, Roth 401k has no income limit, right? So you could be making a lot of money and you could still be contributing to a Roth 401k, and there's no income limit on that. Whereas for a 401k, you're not going to be able to contribute. There's a cap limit of 305k. There is a limit on that. But for a Roth 401k, you don't have any kind of limits on that because it's usually post-tax dollars. They usually don't have any scrutinization on that. So that's kind of a quick thing about 401k and Roth 401k. I know, Madhavi, you asked about people that are contractors and essentially don't have access to 401ks and all that. For those folks, I think the best thing to do is to put money away in IRAs, right? So individual retirement accounts. The limits for the individual retirement accounts are lower, right? As we talked about with 401ks, it's $20,500. With an IRA, it's only $6,000. But if you're over 50, it's $7,000. So you can put in $1,000 more if you're over 50. But IRA limits are only $6,000, and over 50, it's $7,000. And you also have Roth IRA options. Same thing applies. The same way 401k and Roth 401k works, IRAs also work. IRA, anytime you're putting money into an IRA, it's essentially pre-tax, if you will, right? Or you can take a tax deduction on that. But Roth IRA would be post-tax dollars. So you already pay tax on it. So it'll go tax-free. And then when you withdraw it, it's also tax-free. So that's why it's kind of a wonderful vehicle, to do both Roth IRA. But Roth IRA actually has limits, right? Not unlike Roth 401k, Roth IRA has some limits. So if you make more than $144,000 as a single person, or if you're married and you're making more than like $214,000 combined, you're not going to be qualifying for Roth IRAs. So you can't put money in there. Right. And then usually after some time, after 129,000, if you make more than 129,000, it phases out, meaning that you can't put the full $6,000 in a Roth IRA. You can put a smaller amount in there. So it doesn't let you put in, and it phases out. So it goes from 6,000 to 4,000, 5,000, 3,000, 2,000, and 0 once you make more than $144,000. So it doesn't really help you. There are some other ways we can talk about it at a later point, how you can roll over your traditional IRA dollars into a Roth IRA, but you might not qualify for a Roth IRA depending on the income level that you have. But regular IRA, you can fund into a regular IRA or a traditional IRA, $6,000 or $7,000, depending on your age, every year. But you may not be able to take a tax deduction if you make a lot of money on the IRA also. But it's good to put money away, regardless of where you fall. So if you're younger and you're making less money, you have access to IRAs, put that money in there. Roth IRA, maximize, put money in there because you're in a lower tax bracket now. So, take advantage of it. If you're a contractor, do the same thing. Use the IRA or use the Roth IRA if you qualify for it and put money away. And take the tax deductions when you file for your taxes for the traditional IRAs as well.
Yeah, this could be a whole topic by itself, looks like. And Durga, before we move on, we have quite a few questions that are in the chat. So let me go over. I'll start off with the ones that are relevant to the retirement funds that we discussed now. What is your suggestion on funding annuity? It's another retirement account.
We should cover annuity another time because I think that will just take it into a very different direction. I will suggest that we cover that another time.
Okay. And then how to identify the best funds in 401k plans?
It's a very good question. Again, I would like to cover this another time, but I'll answer it very quickly here. It's especially 401k is offered by your employer. So usually they have funds that they've chosen for you, right? So they will they'll give you access to 20, 30, 40 funds that they've chosen specifically for their employees, right? So the way you would do that is when you log into your 401k account, you can go and research these funds, right? You can look at the fund performance, fund portfolio. You can read the information on the fund. And typically what you should be looking at is the rate of return, right? So that's the interest rate that you're going to get, rate of return. And that would be like if you look at a fund and then it says that, it's giving, this year it gave you 30% rate of return. But that's not enough. You should be looking at the history, right? If this fund was available for the last 20 years, how did it perform all these years? So in the last 5 years, what was the average rate of return? In the last 10 years, what was the average rate of return? And you continue to look at all of that. And you also look at what the fund is doing, right? The fund is actually putting money in different stocks or bonds and things of that sort. Again, these are all terms that I would love to cover and another point, but they're investing in stocks and particular stocks. So if you look at a fund and they'll say, they're investing in Apple, Microsoft, Costco, and other things, you kind of know that they're putting money in tech stocks and they're putting money in retail stocks, they're putting money in energy stocks, they're diversifying it. So most funds are diversified, but you also need to see how much risk associated with it, right? 1 year you saw a big rate of return, but the next year you didn't see, there was not much of a return. So you kind of have to evaluate these funds one by one, and then basically say, okay, based on my retirement strategy, right, where I am. So if I am right now 55 years old and I'm going to be retiring soon, I don't want to put anything in a risky fund at this point, even though there may be high rate of return on that. I don't want to put it in a risky fund. So it actually matters on it. It depends on, it's really personal, right? You have to take the age factor. You have to take your risk tolerance, even if you may be young, but you don't want to lose money. And so you want to put it in the safest fund possible, which will also not give you the big return, right? It's going to give you a modest return. So you should be comfortable with these types of things. So you have to evaluate these funds to understand those. The simplest way most people do this, but I don't actually suggest it, is usually there are target date funds. What I mean by that is, if you are born in 1990 and, so you're going to be retiring at 67, which means that you're going to retire in 2057, right? Because you're born in 1990. So usually if you're working for a company, they'll have a fund called Retirement Fund 2057, which means that this is for, people that are retiring in 2057, and they have made sure that the fund was designed in such a way that it takes your age and everything into account, and it slowly changes the way the portfolio is managed, so that it's less risky when it gets closer towards your retirement, and it's more risky upfront because you're younger, you can tolerate more risk. So the fund managers are going to manage it very well. So that's an easiest way. If you don't know where to start, you might start with the target date fund, which is whichever year you're going to be retiring, use that target date fund. And that's how you will be able to, put all your money in there. Usually they'll manage it, but you might not be happy with the rate of returns. That's why you can do your own research and look at all of the funds and look at the fund performance and make sure that you're choosing the right thing for your risk profile.
Thank you, Durga. More on 401ks. Can you contribute and maximize a 401k as well as Roth IRA? I believe you've touched upon this, but.
Yeah, actually there is Roth IRA, certainly if you fall into the tax, Roth IRA has limits with income, right? I just told you. If you make anything less than $129,000, you can contribute the full $66,000 in a Roth IRA. Whereas if you're over that 129 and then you go up to 144, you have a phased out thing. You can only contribute a certain amount of money, less than 6,000. But after 144,000, you can't contribute any. So you could be maximizing your income, your contribution on the 401k side, but on the Roth side, it's purely dependent on how much money you make, on a yearly basis. And you have to fall into the category. Otherwise, you can't fund a Roth IRA. But if you do make less than $129,000 a year, you can certainly maximize your 401k and certainly maximize your Roth IRA. Absolutely can do that.
Thank you. From another question, it's not a question exactly. This is an extremely useful session. Really appreciate NATS team for putting this together. Can you please provide a link to the recording? Because this is a lot of information to take in and so need to listen to it a couple more times. I'm sure we're going to have the recording out there. So we should be good on that. Next one, is there an income limit for a non-working spousal contribution, assuming working spouse has maxed out on 401k?
So if you're a non-working spouse, you can certainly contribute to an IRA, but you obviously don't have any 401k contributions because you're not working. So the only person that is able to contribute is the spouse that is working. If you're a spouse that's not working and is dependent on the other spouse, then you can certainly fund a IRA. And the way you would do that is there are some conditions there too, but you can fund an IRA through your spouse's income, right? But you need to show that the spouse is making enough money to cover the IRA amount as well, right? So they're making enough money to cover that, whatever, $6,000 and whatnot. So technically, if you're a dependent spouse, you can contribute to an IRA. Make sure that you're able to cover all of that, right? You're not, the income of the working spouse can cover all those the contributions.
Okay. Is there a document on NATS Facebook page on the information on 401k or Roth IRA, etc.? So we don't have anything, we just have the recording, but on the other hand, maybe Durga, you can answer this question. You have the aid group where you have all the information and put up. So
yeah, no, I mean, if anybody's interested in joining aid, we can certainly send some information out, maybe through the NATS team. But we have, aid group, meets once a week on Sundays, and we cover a variety of topics, and certainly we cover a lot of these types of things, and we can certainly go into a lot of detail there as well. But what I would suggest is a lot of this information is available on Google, right? Go and Google it yourself. Now that you know, our job is to point you in the right direction, and your job is to go and do the additional research, right? The whole reason why we're not sharing a whole lot of information here, and even though whatever information I've shared can certainly feel overwhelming and feels like a lot of details, it's still not detailed enough. I can just tell you that, right? There's a wealth of information out there that you can access very quickly. So search for 401ks versus Roth 401ks. What are the advantages of one versus the other? There's a website called Investopedia. You can go there to do a lot of research on 401k and Roth 401k and all the other different variety of financial concepts. Google is your friend when it comes to this. So Google it, look at multiple articles, read up on those things. Here we try to cover the most common questions, right? Especially in this, for the Telugu community and in generally Indian community. But Google is your friend. I would say go search and look up multiple sources. Don't ever rely on one source. Look up multiple sources to make sure that you're getting the right information.
Yeah, we have more questions on aid. What is aid and how can we join aid to learn and discuss topics about investing?
Yeah, aid is the group that I've started last year, and as I think we've touched upon earlier in the conversation, that it was a group that was started to empower women to make good decisions, financially, career-wise, and life decisions. And we focus on educating women on a variety of financial topics, to begin with, and we're doing a whole bunch of other things. So it's a WhatsApp group. We can certainly provide, I don't know whether the NATS team can actually send out any information to people who joined, or we can put something on the Facebook page about aid and link to join the group. And probably I have an email address as well that I can share with folks on the Facebook page that you can go and check it out.
What is your recommendation where to contribute if your tax bracket is high, Roth or traditional?
I think you should always think about what is comfortable for you, right? Roth, each one has its own advantage. A lot of the times what the rule of thumb is, if you know you're going to be in a higher tax bracket closer to retirement, they always suggest use Roth, maximize Roth. But if you think you're going to be in a lower tax bracket, put all your money in 401k, right? So it depends on which one makes more sense. The average income of, in America is in the 40,000 range, right? We're talking, very low. For those folks, Roth doesn't matter, because when they get to retirement, they're not in a really high tax bracket, so it doesn't matter. But if you think you're already making money, you're 30 years old and you're making a ton of money, and you know that money is just going to increase, the income is just going to increase, it makes more sense to put a lot of money into 401k, Roth 401k instead of 401k. But a good combination, of the two would be better to begin with. And then, as you're making more and more money, you clearly know that you're going to be in a higher tax bracket closer to retirement. I would just do Roth 401k.
And Durga, I don't know if you'll be able to get to your next question, next topic, but then because we have quite a few questions here.
Social Security.
Yeah. So what if you're currently in a high tax bracket? Does it make sense to do Roth? What do you recommend for somebody who's getting close to 59 and a half?
So Roth has some other limitations, which I did not talk about. So whether it's Roth IRAs and Roth 401ks, they have a limitation. You can't fund Roths. Once you start funding a Roth, you have to leave the money there, not take it out for 5 years. After that, you can take it out. But I would say there is another limit. So once you hit 59 and a half, but you have not funded your Roth for more than 5 years, or it's been less than 5 years since you funded your Roth, you can't take the money out. So that's kind of another problem with that. So make sure that you understand that. Again, I can go into a lot of detail. It might just confuse people. So there's a lot of combinations of things when it comes to when you're closer to 59 and a half, what you need to do with that money. So Roth has that 5-year limitation. Once you start funding it, at least that it should be funded for 5 years, or it has to be open for 5 years before you can start withdrawing from it. And I believe if you hit the 59 and a half, even then it would expect you to have 5 years of funding before, at least it has to be funded. It has to be open for 5 years before you can actually take the money out. So I would be careful about that aspect. But otherwise, if you have you've been funding your Roth IRA or 401k, and you have money in 401k, starting 59 and a half, you don't have to pay a penalty on any of it, but you would have to pay a penalty to take the money out of Roth as well, if it is below the 5-year mark. So there's a 10% penalty, which is a flat 10% penalty if you're taking it before a certain age, which is 59 and a half. But Roth has that 5-year, rule as well.
Can I draw everything at one time when I reach retirement age, like 65 years?
You can, if you want to, but I don't know why you would, because you would be depending on whether that's taxable or not, right? You don't want to be taking too much money out and paying a lot of money in taxes. If it's Roth, you certainly will be able to take it out. But there is also another flip side to this, which is if you reach a certain age and if you're not withdrawing money, there is penalty also. 401ks have some penalties. If you reach 70 and a half years of age and you're not removing money from your 401k, there are penalties to that. So once you reach 70 and a half years of age, you should be taking, there is a minimum amount that you should be taking out of your account. So that is called the required minimum distribution, RMDs, they're called those, but Roths don't have that. That's the advantage of a Roth 401k or Roth IRA. You don't have to take money out at all from your account if you don't want to. And you can continue to keep the money and then pass it on to that money to other folks as well. You're not paying taxes on it, but if they get the money, they will have to pay taxes on it. That's a different story. But technically, once you put it in a Roth, there are no minimum distributions that you need to take. So you can take the entire amount of money out, or you can just leave it until you're 90 years old. You can do that as well. And you can take the money out then if you want to. But with 401ks and IRAs, you can't do that. 401ks and traditional IRAs, you have to take money out starting 70 and a half, if not earlier, right? So, retirement age is 67, you're expected to take money out at that point. And if you take all of the money out at the same time, you will not pay a penalty, but you'll be paying taxes on those. And you'll fall into a higher tax bracket too, because you've withdrawn $1 million now, you'll be in the highest tax bracket and you'll be paying really a lot of tax, right? 35% tax, which means $350,000 will be gone just for tax. So want to be careful, right?
Right.
How much money you're withdrawing.
Next question. While working, we don't know on Roth 401k, we have some income from prior work years. Can we contribute to Roth 401k as a non-working person?
No, you can't. You can't put it into any Roth 401k instrument. If you worked in the past, but you can't actually put that into a Roth 401k because Roth 401k is only offered through an employer. So you obviously cannot put that in there. But you can certainly contribute to a Roth IRA if you essentially, if your spouse is making enough money and you can contribute to it, you certainly can put the money in the Roth IRA. But there's also some things you could, if you left it in the previous employer and they offer a Roth 401k, you can probably roll it over into a Roth 401k at that point. So you can certainly talk to your previous employer's, retirement, plan fund company, whoever that is, Vanguard, Fidelity, some of these big ones. You can talk to them and look at the options there.
Yeah, we are almost on top of the hour here, Durga, but I think I'll go ahead and continue with the questions that we have in the chat. Advantage of converting from 401k to IRA.
Okay, that's a great question. So you can only do that when you leave the company that you have been with and you had a 401k plan with. So I was with one employer, maybe my first employer, right? And I put in $50,000 towards my retirement with that employer. Now that was in the 401k plan. Let's assume that's not complicated with Roth and all that. Let's just say it's 401k. And then I leave that company to join another company. Now, this other company also offers a 401k plan, and I'm starting to contribute there, right? But I have money left over. My 50K is still with the old company's 401k plan. Now, because I left that company, I can take that money and roll it over into an IRA. And that IRA can be with any brokerage firm, right? You can go to Fidelity, any of the big brokerage firms that you have. You can open the IRA there and roll the money over from there. The main advantage of doing that is because the 401ks the 401k is being managed by the employer. They usually they've chosen the funds for you to invest in, right? So those are limited. You have 20, 30 funds that you can pick from. That's it. You can't do anything more. With an IRA that's independently managed, because it's called individual retirement account. Once you roll the money over, so take that 50,000, put it in an IRA, and now you can invest in a lot of your options open up. You don't have to invest in those 20, 30 funds that were there because now you moved everything over into an IRA. Now you have a lot of options available. You can put them in individual stocks and bonds and ETFs and REITs and all kinds of different investment vehicles that you can find. So now you're free to do a lot of things, and you might be able to get more of a return by doing that. And because you're able to manage it better, you can manage it very granularly rather than the way they had done it before. So you're just trusting that the funds are good, and you do still have to research your funds and make sure you're diversifying there, but it doesn't give you that granular control that you would get with an IRA.
This is not related to 401k, but let me see if you can answer this. When you say 8 to 10 times the income, the goal at 60 years in retirement, is this related to net income?
It should be gross income, right? Because you still are going to be paying taxes otherwise. So if you were making $100,000 just prior to retirement, right? Then 8 to 10 times when you're in your 60s, you are supposed to be, at least you have to have saved about $1 million, because 10 times 100,000, you should have saved about $1 million towards your retirement to be able to then comfortably retire. Because just remember, when you retire, most people these days live longer, have more medical expenditure generally. When I say longer, typically people live 20 years past their retirement life. So you have to think about funding for that long, right? So once you retire and you're no longer working at 67, if you live till 87, you need to make sure that every year you're able to get, 80% of your pre-retirement income, which means that you need to save a lot of money, to be able to do that. So just keep that in mind. People live for 20 or more years longer, and especially women outlive men. That is a stat. So again, you're thinking about your family, but always think about women outlive men. So, more money needs to be put away to make sure that even if one spouse passes away, the other spouse, especially if it's a woman that's left, that's still alive, they still need to have more money to survive. So that's important.
The next question is about the HSA contributions. When can you contribute to HSA and when we are not supposed to contribute to HSA?
When there are limits to HSA, again, we were supposed to cover that. Again, Social Security, we didn't get to an HSA, but HSA has limits. I believe it's $3,650 now for individual. If you have a high deductible plan, you can't fund an HSA if you don't have a high deductible medical plan. If you have that, that's when you can contribute. I think we had a question last time. Somebody has asked about what about if I went and purchased my insurance high deductible plan on the exchange? And the answer is yes, you can still fund an HSA, but there are limits. So if you're an individual person that purchased medical insurance and this high deductible plan, you can fund $3,650 towards the HSA. If you are a family that purchased a high deductible plan, you can fund, you can fund about $7,300 into your HSA. So that's the full amount. But that's, again, the limitation, right? You can't fund anything more than that. So maximum is $7,300 that you can fund for this year. Every year the number changes. So this year it's $7,300. Last year was $7,200, I believe. So it does increase, but that's the amount you can actually fund into an HSA.
The next question is how to roll over traditional IRA to Roth IRA.
So that, again, you can, so the trick there is you can do that as long as you're willing to pay the taxes. You have to pay taxes though, because you're rolling over the traditional IRA into a Roth IRA. Roth IRA will always take post-tax dollars. They're not going to take pre-tax dollars. So let's say you have $100,000 in a traditional IRA. Maybe initially you put in $50,000 into IRA, and that was tax deductible. And then it grew by another $50,000. Now you have $100,000 in the traditional IRA. You're paying full taxes, which means that if your tax bracket is 22%, and if it's $100,000 you take out of your traditional IRA to put it into a Roth IRA, you have to pay 22% taxes on the $100,000, which is you'll have to pay $22,000 in taxes before you can put the money into it. So you don't get the full 100K into a Roth IRA. It's going to be 78,000 that goes into a Roth IRA. That's how it will be. So you have to pay taxes on the additional contribution as well as the gain that you have.
Thank you. Would you cover backdoor Roth IRA?
This is the backdoor Roth IRA. I just covered that. Yeah. This is the backdoor Roth IRA, but it might go away as well. Right now, the Biden administration is actually reviewing the backdoor Roth IRA because a lot of very high net worth individuals are taking advantage of it. And so, Biden's administration is looking very, very closely at it. It might go away very soon. So if you have not taken advantage of it, take advantage of it now.
Is it good to do backdoor Roth IRA for high income earners? Related.
It depends, right? If you're already in the highest tax bracket, you're paying tax now. So whether you pay it now or whether you pay it later, I guess it doesn't matter. That's why the Roth one is a tricky one. I think Roth is useful when you are, younger, because you're in a lower tax bracket as well. So it makes sense. But if you're already at a high, you're in the highest tax bracket, then probably makes not a whole lot of sense, because then you're going to be paying taxes. The only way you should think about it is that you're going to not pay taxes on the earnings, which is great, right? Because you're not going to pay any taxes on the earnings. So your principal amount will be taxed before it goes into a Roth. But the growth that it's going to have, if $50,000 was put in post-tax, but it grows, by another $50,000, when you're not paying taxes on the $50,000 it grew, right? In 401k, or the traditional IRA, you're going to pay taxes on everything, the growth as well as the initial amount and everything. So Roth will make sense. I mean, most of the time Roth makes sense. I think what most people say is wealthy individuals always say, take advantage of Roth. And most people don't take advantage of Roth. So I would say if you can, do it, because the growth is not going to be taxed also. And you're younger now and you're in a higher income tax bracket, it makes more sense to do that because you have a long time for those earnings to increase.
Is there any minimum amount that you have to withdraw after 59.5 age?
There actually, it's not 59.5. You can withdraw without a penalty because 59.5, most people can retire early, but your actual retirement age is 67. So just keep that in mind. It's not 59.5, and 62 is early retirement. But after 59.5, you don't pay a penalty to remove money from your 401k. That's the thing. There is nothing, the minimum, I don't know about the required minimum distributions. I think depends on how much you have in retirement. I think that's what it depends on. I don't know if there was any, but you are supposed to be taking minimum distributions once you hit 70.5, right? That's what we know. 70.5, you need to take money out at that point. And I don't remember if that is a set amount, it's a 5%, or I don't remember what that is. I don't remember reading that anywhere either. But it also depends on how much money you have in your retirement account also, I think. But it's a good question. I have to go, find that information myself.
We have a question related to the credit cards. College-going kids should have should we give them bank debit cards or credit cards? Open credit cards on their name as primary holder.
I would say no debit cards. Give them make them an authorized user on a credit card. That way they'll build the credit history. No debit cards. I would say suggest not for even the adults. Don't use your debit cards. Use your credit cards, but paid in full. And that's how you're going to keep your credit history strong and your credit score strong.
Sure. Yeah, and then we have quite a few questions, or not questions exactly, but around aid. People would like to know more information about aid and how to join aid. So maybe we should share that information somewhere.
Yeah, like I said, I think we should put that information on the Facebook page for NATS, and then we can go from there, because I think it will be hard to share this information here. I do have Madhavi, I think I shared something with you. There's a link if you want to open that up. I sent something to you earlier. There was a link for the aid information. We can probably quickly flash that information on the page. But I can put the invite link and everything on the Facebook page, hopefully.
And so I believe, Durga, you had more questions. Sorry, you had more topics to cover for today. But since we do not have that kind of time today, I'll leave it to Aruna Garu to see if we have to do another session. And would you like to? Yes, at this point, Durga?
No, I think we wanted to talk about Social Security. I think, I certainly thought we'll be able to cover Social Security, but I knew 401k is opening a can of worms, right? People have a lot of questions about that. But Social Security is something that we would like to cover. So I think we may have to do a third session here on Social Security and kind of the remaining topics. So I think in conclusion, I think we've covered the credit score today, and how to calculate why it is important, about credit history and credit reports and so on and so forth, and really we try to cover as much as we can on the retirement stuff, 401ks, and through the questions we covered some things about HSAs and stuff like that. But Social Security is something that we will come back to at another time.
Thank you, Durga. I'm actually sharing the information to join aid. We have a Google page for the member list. Do you want me to share the spreadsheet that we have?
No, actually, I sent you a presentation that you can actually open up if you have it.
Okay, I'm still looking for that.
Okay, that's fine. I think we can put that information on the NATS Facebook page.
Okay, yeah, let's do that. There's one more question, if you don't mind taking it. Is it true Roth IRA could pass it to children without tax?
It's not without tax. If you pass it to children, they will have to pay tax when it becomes their money, right? So it's not entirely true that they will not pay any. Once they get it and that becomes their income, and once they would have to pay some taxes on that. I am about 95% sure that is the case, but I can check again and let you guys know. But that is what I know.
All right, that's all for today. I think we took care of all the questions. Thank you, Durga. Thank you very much for your time. We've covered quite a few topics today: credit score and retirement. So probably we might have to do another session if needed. Then, unless you have anything else, I'd like to turn it over to Jyoti Garu.
Thank you, everyone.
Thank you.
That's a very, very useful and very long and so much excitement and inputs from people, a lot of questions. Though we are prepared to cover social security, we were bombarded with a lot of questions, which is good. That kind of input and feedback is coming from the participants. Wonderful. And Durga Garu, we really, really appreciate for your time and patience, understanding the people's questions and concerns and answering them so that they can be helpful for them. Very nice. So many things we have covered. As you said, ప్రయత్నం చేస్తున్నాం wellness health check లాగా మన wealth check and wellness is what we are doing. పెద్ద ప్రాబ్లం ఉంటే మళ్ళీ స్పెషల్ గా వచ్చి చూడాలి ఫైనాన్షియల్ డాక్టర్ ని. ఇవాళ కొద్దిగా అన్ని చూపించాం, ఇలా ఉండాలి అలా ఉండాలి, క్రెడిట్ స్కోర్ ఎలా చూసుకోవాలి. వండర్ఫుల్ పాయింట్ దట్ ఏమంటారు మీరు, యంగ్ ఏజ్ నుంచి రిటైర్మెంట్ వరకు ఉమెన్ కి కిడ్స్ కి ఎలా చేయొచ్చు అనేది వాళ్ళ బ్రాడ్ స్పెక్ట్రమ్ లో మీరు సింపుల్ పాయింట్స్ చాలా బాగా చెప్పారండి. వెరీ యూస్ఫుల్. ఏమంటారు, మిలియన్ తీసుకోవాలా పెన్నీ తీసుకోవాలా అంటే అందరం యూజువల్ గా చేసేది మిలియన్ ఎక్కడ పెన్నీ ఎక్కడ. తెలుగునాడు ఎవడైనా కానీ మిలియనే తీసుకోవాలి. కానీ ఆలోచిస్తే కనుక ఆలోచనలో ఒక సూత్రం మర్మం అనేది ఉంటది, దాన్ని ఆలోచించి అడిగేయాలి అనేది చాలా బాగా చెప్పారు ఇవాళ. అంటే విన్నవే మనం అలా ఆ టైంకి వినడం అనేది మనకి చాలా యూస్ఫుల్ గా ఉంటుంది. సో తెలుగులో చెప్పాలి అంటే ఇవాళ నాకు డబ్బులు సంపాదించడం కంటే కూడా ఈ అమెరికాలో అప్పులు చేయాల్సిందే, అప్పులు చేయడం అనేది ఇంపార్టెంట్ అనేది ఇక్కడ కల్చర్ నేర్పిస్తుంది. బట్ చేసి ఎంత బాగా మేనేజ్ చేయాలి అంటే మనం సంపాదించింది దాచుకున్న అప్పు చేయాలి, అప్పుని జాగ్రత్తగా తీర్చుకోవాలి అనే పద్ధతి ఇక్కడ నేర్పించడం అమెరికాలో. అది తెలియక అమ్మో చాలా మంది మనం ఇండియన్స్, నాకు తెలుసండి దుర్గా గారు, అంటే మనకి ఇంత సంపాదిస్తున్నాం అప్పెందుకు తీసుకోవాలనే మోడ్ లో కూడా ఉండి చాలా టైం తర్వాత రియలైజ్ అవుతారు క్రెడిట్ స్కోర్ అంటే ఏంటి, అసలు అప్పెందుకు తీసుకోవాలనే ఆలోచనలో. బట్ మీరు చెప్పారు నెవర్ క్లోజ్ ద క్రెడిట్ కార్డ్, మెయింటైన్ క్రెడిట్ స్కోర్, పే ఇన్ ఫుల్. ఎస్, మనకున్న డబ్బులు ఇక్కడ అంటే ఏ కాలానికి తగ్గట్టు ఏ ప్రాంతానికి తగ్గట్టు అనడం అనేది. సో అది కొంచెం లేట్ గా నేర్చుకునే పాయింట్ ఇవాళ మీరంటే యంగ్ కిడ్స్, ఐ విష్ లాట్ ఆఫ్ యంగ్ కిడ్స్ ఆర్ ఆల్సో లిసనింగ్ అండ్ అండర్స్టాండింగ్. సో సూనర్ గా వాళ్ళ క్రెడిట్ కార్డ్ ఓపెన్ చేయడం, పే చేయడం, చిన్నగా ఆ టిప్స్ అన్ని తీసుకుంటే చాలా చాలా బాగుందండి. అంటే ఏమంటారు, వాళ్ళు వింటున్నప్పుడు మేము కూడా వింటున్నాం కదా, మళ్ళీ విని సూక్ష్మము మర్మము జాగ్రత్తగా గుర్తు పెట్టుకోవడం, రీటైన్ చేయడం, దాని మీద వర్క్ చేస్తే చాలా బెనిఫిట్స్ ఉన్నాయండి. అండ్ రియల్లీ మా నాట్స్ అరుణ గారు ఈసారి చైర్గా ఉండి ఇలాంటి మంచి కార్యక్రమాలను ఉమెన్ కి జస్ట్ ఎంటర్టైన్మెంట్ కాదు, మనం ఎడ్యుకేషన్ ఇవ్వాలి. హెల్త్ తో పాటు వెల్త్ ఈజ్ ఆల్సో ఇంపార్టెంట్. అన్ని రకాలుగా మనం వెల్ రౌండెడ్ వెబినార్స్ కానీ సెషన్స్ కానీ ప్లాన్ చేద్దాం అన్న టాపిక్ లో మిమ్మల్ని తీసుకొచ్చాం మేము. సో 1 సెషన్ పై 2 సెషన్ పై 3వ సెషన్ కి వాళ్ళ నాంది అయ్యింది. ఇంకా లాట్ ఆఫ్ ఇన్ఫర్మేషన్ కవర్ చేయాలనే ఇంట్రెస్ట్ తెలుస్తుంది. తప్పకుండా అండి, యాజ్ నీడెడ్ తప్పకుండా ప్లాన్ చేస్తాము. సో నాట్స్ వాళ్ళు ఎప్పుడు కూడా సేవ, భాష ఈ రెండింటికి కూడా మంచి వాల్యూ ఇస్తా ఉంది. దాని ప్రకారం సేవ కార్యక్రమంలో ఉమెన్ కి ఎంతో కొంత బీయింగ్ ఏ ఉమెన్ చైర్ గా గారు సాధించడంలో ఎన్నో మంచి కార్యక్రమాలు చేయడంలో ఈ పార్ట్. అండ్ డెఫినెట్లీ చాలా పేషెంట్ గా మాధవి అన్ని క్వశ్చన్స్ అందరివి కవర్ చేసి అన్ని అడిగి మంచిగా ఇన్ఫర్మేషన్ ని షేర్ చేయగలిగాము. మాధవి గారు అండ్ దుర్గా గారు కాంబినేషన్ ఇస్ వెరీ నైస్ గా, చాలా ఏమంటారు కూల్ గా చక్కగా ఏది మిస్ అవ్వకుండా కవర్ చేసాం. బట్ ఇంకొకసారి మిగిలిన టాపిక్స్ కూడా కవర్ చేద్దాం మాధవి గారు. థ్యాంక్ యూ సో మచ్. అండ్ నెక్స్ట్ మా టీమ్ అండి, హోల్ టీము మేమందరం కూడా సైలెంట్ గా విన్నా కానీ ఈ ఈవెంట్ జరగడానికి అందరం కలిసి సమిష్టిగా కృషి చేయడం అండి. అందులో సుధీర్ గారు మాకు వెబ్ చైర్ గా ఉండి చాలా మంచి కోఆపరేషన్ తో ఈవెంట్ కి ఏ ఇది లేకుండా చేస్తారు. బిందు గారు, గీతా గారు, ఉమా గారు, లక్ష్మి గారు, జయశ్రీ గారు, మేమందరం కూడా టీమ్ లో ఉమెన్ టీమ్ లో ఉండి ఇలాంటి ఈవెంట్స్ ని తీసుకొస్తున్నామండి మేము ముందుకి. తర్వాత నాట్స్ ప్రెసిడెంట్ విజయశేఖర్ అన్నయ్య గారు అండ్ బిఓడి చైర్ ఉమెన్ అరుణ గారికి కూడా మా ధన్యవాదాలు ఇలాంటి మంచి కార్యక్రమాలు తీసుకొస్తున్నందుకు. ఇంకా నాట్ బట్ నాట్ ద లీస్ట్ అండి, ఇలాంటి ఎన్నో కార్యక్రమాలు వస్తూ ఉన్నాయి. యాజ్ యూ సెడ్ ఇట్స్ ఎ పాజ్ మాధవి గారు దుర్గా గారిది. నెక్స్ట్ మళ్ళీ ఎప్పుడు అవకాశం ఉంది, ఎలాంటి టాపిక్స్ తీసుకొని వద్దాం అనేది మళ్ళీ మనం బ్రెయిన్ స్టార్మ్ చేసి నెక్స్ట్ కార్యక్రమానికి తీసుకెళ్దామండి. నెక్స్ట్ కమింగ్ ఈవెంట్ చిన్న మార్పుతో కంటిన్యూస్ గా ఫైనాన్షియల్ కాకుండా, అండ్ మార్చ్ ఇస్ ద మంత్ ఆఫ్ ఉమెన్ సెలబ్రేషన్ అండి. సో ఉమెన్స్ సెలబ్రేషన్ ఈవెంట్ వీఆర్ ప్లానింగ్. ఆ డీటెయిల్స్ అవన్నీ కూడా మేము షేర్ చేస్తామండి. మార్చ్ 2nd వీక్ 13th ఫైనలైజ్ అవుతుంది. ఆ డీటెయిల్స్ మీకు అన్ని షేర్ చేస్తాము. కీప్ ట్యూన్ ఇన్ టు natsworld.org ఫర్ మోర్ ఇన్ఫర్మేషన్. మీకు అన్ని రకాల ఇన్ఫర్మేషన్స్ షేర్ చేస్తా ఉంటామండి. So once again, thank you so much for spending quality time and women empowerment. అంటే ఈ ఫైనాన్షియల్ ఎడ్యుకేషన్, ఫైనాన్షియల్ డిసిప్లిన్ కూడా అంటే ఇంట్లో మగవాళ్ళు సంపాదించినప్పటికీ కూడా స్త్రీకి, అమ్మకి ఈ ఎడ్యుకేషన్, ఈ నాలెడ్జ్, ఈ ఇన్పుట్స్ ఇవ్వడం వల్ల కుటుంబాలకి ఎంతో మేలు జరుగుతుందన్న ఆలోచన అండి. So we hope all the women has got some good feedback, good feed and information to take to the next level. And thank you so much and really appreciate. Arna garu, you want to add anything andi?
Sure. మీరు ఆల్రెడీ కవర్ చేశారని నేను. థ్యాంక్ యూ దుర్గా గారు, థ్యాంక్ యూ మీరును మాధవి గారు. We really are bombarded with a lot of questions that only reflects the importance and the value that your session has given. So we are very pleased with the reactions and definitely we'll చూసుకున్నప్పుడు we'll definitely have another session on social security, that's for sure. We'll wait for that. Because we don't want to bombard everybody every month only on financial wellness. We will definitely take a break and definitely we will come back with a lot of with more insights from you. As I'm sure you will probably be getting a lot of interest from our viewers to join your aid, which is I'm sure a very good thing, and lot of interest in joining aid Kabati. That's it's wonderful. It's wonderful to see a lot of people seeing the interest, and it would be nice if we welcome your suggestions, viewers. We welcome your suggestions and concerns, not concerns, I would say welcome your suggestions on whatever you want to see next going forward. If you have anything that you want covered, and we would definitely try to bring it on to you. If there's any particular topic of interest that you would like, we would definitely want to bring it to you in future. So please be in touch with info@nats.org and natsworld.org if you want to go check it out and become a member, and let us know your feedback. That would be of importance to us to plan our future events. So, and definitely I thank you Durga garu, thank you garu, thank you Lakshmi and Jayashri garu, everybody.
Thanks Arna garu. Yeah. Thank you so much for your good words. Okay నండి, మళ్ళీ నెక్స్ట్ మంత్ నాట్స్ ఉమెన్స్ డే సెలబ్రేషన్స్ లో కలుద్దామండి. March 13th 11 o'clock EST, 10 o'clock CST for a change of celebrating the women. Please join us and have a wonderful weekend. And thank you. ధన్యవాదాలు.